51.0. So clearly some issues with tariff prices probably in the Philly Fed number, and that's the only one that's listed for May. So that's the latest data, and make of it what you want in the markets.
Mike McKee, thank you, sir. It looks like PPI is the main character in this movie this morning. Off the back of this economic data, a downside surprise there, just unlocking slightly lower bond yields across the curve. If you turn to the bond market, just look at a snapshot of the curve, the 2-year, 10-year and 30-year. Yields briefly dropping below 450. Back to those levels at the moment. We're down about 2 or 3 basis points across the curve on a 2-year, just north of 4%, where we have closed every single day so far this week on a 2-year yield. Lisa, just a slight downside surprise on PPI.
Yeah, so you have that coming after the slight downside surprise on CPI. I'm going back to the control group of retail sales. I think that's important, the fact that it came in a negative figure. It came in at negative 0.2% versus the expected 0.3% gain. And the fact that this is not causing more of a rally in the long end of the yield curve is notable. You do see a little bit of a bid into 30-year yields, but still 4.96%. This to me highlights something else is really driving this, and it's hard to really understand the forward look from data that portrays that, yeah, there are some cracks in the consumer right now.
We can go back to Mike McKee for a second look, so let's choose just that. In just a moment, we can talk to Mike about retail sales, PPI, and jobless claims. Mike, you're taking a second look at things. What do you see?
Well, there is some effect of the tariffs in some of the PPI goods numbers, a 9.4% rise in the index for cold-rolled steel. Indexes for electric power, utility natural gas. We already saw that in the CPI all went down a little bit. Prices for primary basic chemicals also moved lower. But it's really a services story in the PPI here. Prices for services were down by, prices for services were up 0.7, or down 0.7, and the goods were unchanged. I got that right now with all this jumping around here. And a lot of that was airfares and also portfolio management. So we did see, as Jamie Dimon said, perhaps not as good a quarter for the banks so far as people might think, given the volatility in the markets.
Mike, thank you. We'll come back to you in about 6 minutes' time to get an update with Chairman Powell, expecting him to speak a little bit later this morning. I want to turn to the equity market, Lisa, recovering. Equity futures down by just 0.25% now.
There is this feeling that the disinflation is a positive thing, and the fact that the headline figure for retail sales coming out positive is also a good thing. I'm not sure what to make of it, though, really, because I don't really have an understanding of just what this data means, how much people are relying on it, how reliable it is for a forward look. And frankly, it just feels like people are watching other things. Maybe it's a headline that just dropped from Doha that really is moving things around.
I've felt like that every single day we've had economic data. It's almost impossible to get a clear read on anything.
Totally. I mean, so if I said to you, well, it's a clear, direct response to the fact that retail sales control group was down 0.2%, I'd be completely lying because I have no clue. There is a feeling that it is interesting that this economic data does not have a very clean read in the market, because the market, I think, feels similarly. What do we make of this if it is messy, if it is backward-looking at a time of very, very quickly moving policy?
Neela Richardson can take a look at things. She joins us from ADP. Neela, welcome to the program. Do your best. What's going on here? Give us a clear picture of what's happening in the U.S. economy.
Good morning. It's mixed, and I think that's what you're seeing in the data. Now, if you're looking really for some good news on inflation, you found it today. And that is the through line. And also, if you're looking for good news on the labor market, you see it continue. So those initial jobless claims still at historical lows, that is helpful for an economy built on consumption. But when you turn to the consumer and you bring in that soft data of consumer being downbeat, and we know that consumers went out and they stockpiled on durables, on cars and vehicles. What we're seeing in April is a moderation from that stockpiling, and maybe starting to really reflect new economic vulnerabilities. We left the last Fed meeting with 2 risks at our disposal. We left the risk of slower growth and higher inflation. And I think that's what the markets are really focused on. That higher inflation risk looks a little less risky today, but you know, every day is a different day when it comes to this economy right now.
Neela, I'm pleased you brought up that topic because I think it's so important. It's been really difficult to try and unpack what is just a front loading of purchases by consumers versus what is genuine, authentic, durable, sustainable demand. And as we work our way through the summer, we've been trying to work this out all morning on this program. Are we going to see the price increases? Is Walmart the one to listen to? As they warned this morning, they can't hold off much longer from here, Neela. How do you gauge that at the moment? What do you look at?
I think the large retailers should be listened to. They are active in this market. They are seeing the prices in real time. So also, consumers are important to listen to in this moment. When they say they're downbeat, they mean it. We don't talk a lot about consumer surplus, and just really quickly from your Econ 101 class, it's the price consumers are willing to pay versus the price they're actually pay. But if consumer surplus is being eroded because they're seeing higher prices, that means consumers will continue to feel downbeat. And those feelings are translating right now into what a data point we'll see on Friday, which is consumer sentiment. And if that continues, it really does reflect that higher risk of continued inflation that the Federal Reserve warned about a week ago.
And this is the reason why, Neela, a lot of people say we don't know how relevant any of this data is because we don't know whether this is just April data and people feeling bad in April. But in May, things are going to look a lot better because we have a reprieve from some of the tariffs and things are looking a little bit easier. The market is rebounding. Neela, how do you look at the quickly moving policy and then judge the relevance of any of this data that is just a snapshot in a very quickly moving movie?
I look for the steadfast, stronghold in the economy, and right now that's the labor market. The labor market is solid. If you look at initial jobless claims, if you look at the pace of hiring, though we see it at ADP to be more modest than it has been in the past, it's still solid. We're still seeing strength, and that is the underpinning of the bulk of the consumers. So as long as the labor market stays strong, stays solid, we still see growth in jobs, we still see wages above inflation, then you have an economy that could weather some of these higher level risks.
How much, Neela, do you see because of that stability in the labor market, in addition to what we are hearing from some of the biggest retailers in the world, that prices are going to go up? How much is a stagflationary-like environment becoming increasingly your base case for the remainder of this year?
It's a risk. It is a risk. I think what we're seeing, collectively in all this data is an economy that looks to be slowing a bit. I mean, the first quarter contraction is also messy given the high degree of imports. So it's again, a backward-looking data point that was based on a lot of stockpiling. But looking forward, if growth slows, not just because of U.S. consumption and U.S. production, but also around the world, if growth is at risk, then you might see slower growth and higher prices. So yes, stagflation is increasingly a bigger concern. In my mind, it was always a concern. I think the dynamics that kept inflation down for 4 decades going into the pandemic have changed dramatically. We don't talk about these longer trends that are affecting inflation. So even without trade policy, that was always a risk. Now that risk is amplified because of some of the uncertainty that we're still seeing on the trade side.
Neela, thanks for jumping on. Thank you very much. Neela Richardson there of ADP off the back of the latest economic data. We saw jobless claims not making much of a headline at all, which is good news. Jobless claims still in at around 230. Slight downside surprise on PPI and both retail sales as well. In a bond market, it means we unlock lower yields. So the front end of the curve down by 5 basis points, just north of 4%. That front end of the curve has been pretty anchored through much of this week, anchored around the view this Federal Reserve cannot cut interest rates anytime soon. On the Federal Reserve, I want to cross back over to Bloomberg's Mike McKee. Mike, Chairman Powell is talking right now. He's addressing the framework review at the Federal Reserve. Any comments at all, as far as you can tell, on anything else?
No, he is not talking about the economy or current monetary policy. This is a sort of a history of the framework review, how they put it into place last time, what went wrong, and what they're looking to maybe fix the next time. Basically, he said the framework was based on the history up to that point, which had showed inflation very, very low, even with strong growth, and so they felt they could let it run for a while. Obviously, that didn't work. He said, actually, they dropped out of this new format, this new framework, in about 2021-22 when inflation started to go up. They didn't say that, but they started going back to the old way of doing it and raise rates quite a bit. And so they're going to think about this for the next time. They're not going to be doing the let it run kind of thing. They realize that inflation's higher on a secular basis now, and they're going to keep an eye on that and watch out for volatility in the markets is what they got to come up with a framework to deal with those things. And he said, of course, we could always do a better job of communicating.
We've had a lot of that, haven't we? Mike, thank you, sir. An update from Michael McKee, the chairman of the Federal Reserve, addressing the framework review. So no comments on the near-term economic outlook or the rate path, at least for now. But this headline might be entering a period of more frequent supply shocks, coming from the chairman of the Federal Reserve.
That is something a lot of people have talked about. We know that Bob Michael, for example, from JP Morgan Asset Management has talked about this as well. What the Fed's response is really a huge question mark. I will say that Andrew Hollenhorst over at Citigroup came out with this, that after the PPI numbers that you pointed out, John, we project 0.19% month-over-month core PCE for inflation. All of this in April makes it an easier choice to cut policy rates once the labor market weakens. So this is the big debate. Does that give them the breathing room to kind of get ahead of what a lot of people think will be a big slowdown in growth?
Let's have that debate right now. Joining us around the table, Christina Campmany of Invesco. Christina, good morning.
Good morning. Thanks so much for having me.
Thank you for being here. At the start of the year, the 10-year was about 456. This morning, we're at 450. The world's changed a lot.
It's been a snoozer. What do you mean? Nothing's happened.
What's the bond market doing in the same place at the start of the year?
Look, there's been, I think, the one continuity that we've had all year is continued uncertainty and massive changes of like, what is the direction? Where are we going? I think we're all sitting here trying to understand the policy objectives of the U.S. administration. And I think the reality is we don't know what they are. So we're adjusting with that. And I think in the last week, you had this pause on China tariffs, and now we have our second rolling 90-day pause. And there's now a shift to, is the administration concerned about growth? Are we going to shift back to hearing about tax policy and dereg? And so I think the market's trying to digest that.
You've got to run a fund, a portfolio, so help us understand what you're positioning for. Are you positioning for a policy mix that leads to higher bond yields in the Treasury market or lower bond yields?
Look, so we've been in kind of a steepener base case camp for probably at least a year now, and the driving forces behind that have shifted, but I think that thesis remains the same. Out the curve globally, when we look at across developed markets and emerging markets, there are very few steep markets. You're not compensated out the curve really to own duration, so we'd rather own our duration in the front end. And even like we've repriced in the last week that twos in the US are now back to 4%, but I think the front end almost looks more interesting elsewhere. We're still pricing through funds. I think the Fed has kind of this push and pull, right? They are concerned with both of their mandates, and they're pulled in opposite directions. And it's more clear, there's more certainty about policy outside of the U.S.
You said something there that was very interesting, that you've had the steepener trade on for about a year, but the reason behind it or the driving factors are changing. What are the driving factors today versus, say, 6 months ago when it was this belief in strong growth and maybe stickier inflation over a longer period of time?
Yeah. So on the growth side, I mean, we're all sitting here, and you guys have talked about it this morning. How do we weed through this data? What is it taking into account? Should we look at April data yet? Do we have to wait till July to get June data to really have clarity? And I think the Fed is in the same situation as us, waiting for clarity. But when we look at the steepener now, I think the long end, we're saying there is fiscal pressure. We need to kind of recognize that. There are inflationary pressures. Even at 5% in bonds, that's not we're jumping out of our seats excited to own duration there, because in the front end you can have kind of risk-free rates at 4%.
What would make you jump out of your chair and say, yes, give me some?
I think, again, when we look globally, the one place that looks interesting, I mean, 10s, 30s in Japan is almost 240 basis points of steepness. I mean, that looks like a dislocation that will need to readjust, and there's some interest there. But I think you need more clarity of, what is the tax policy that we get, and where does that leave us deficit-wise? This 3.33 and talking about a 3% deficit kind of was early out of Washington and doesn't seem anywhere close to kind of these 6 and 7% reality numbers that we're talking about for the deficit.
I've not heard about century bonds for a long, long time. And so I saw your name connected with century bonds. What are you doing with century bonds?
So when we look at it in Europe, we, again, generally have our duration in the front end and have steepener biases. But when we think about portfolio construction, there are some of these century bonds that you can say, I can buy very low dollar price, positive convexity paper, and it balances the portfolio in some way that if you have kind of a breakdown.
What kind of risk does it introduce? What are you exposed to by doing that?
Oh, I mean, again, of course, still in a sell-off, you are exposed, right? A $40 price dollar piece of paper can still go to 20, right? Like we've seen that in the last number of years. But again, we think about it more in a kind of portfolio construction that it adds some positive optionality.
Elisa's in deep thought right now about Austrian century bonds. I haven't talked about an Austrian century bond since TK was on the program, and he used to talk about it all the time.
Yeah, well, they were fluctuating like the way that
it's all
you could say 30-year treasuries are fluctuating right now. One thing that the reason why I'm deep in thought is because as you speak, I'm thinking you're mentioning all these havens, and you're not mentioning even a level that would attract you to the United States long bond. It just highlights the sort of protest that you're seeing among the stalwart investors of U.S. bonds that are taking such a profoundly different tone. Is there any other time in history in your career that you've had this approach to U.S. bonds?
Look, so again, we run global portfolios. So by nature, we're looking kind of more broadly, and then you kind of have to say, what are the factors? And we're more positive, I'd say, on U.S. growth. We still have this dislocation between the soft data weakening and the hard data kind of muddling along, and the labor market exceptionally strong. And Michelle spoke to it this morning about the U.S. consumer. The U.S. consumer has been resilient. And what have we learned from the consumer post-COVID is they shift and they shift quickly. So can the consumer shift more quickly than we are giving them credit for? Perhaps, right? And until you get a labor market breakdown, then you're kind of okay. So I think that kind of leaves us less interested there. And we look at, and if we take a step back and we look at credit and rates and FX, I actually think that the foreign exchange markets are probably the clearest avenue where you see kind of all of this policy play out price-wise.
Yeah. Christina, it's good to see you.
Thank
Ready to catch up. Thank you for being here to talk about century bonds too. Christina Campmany of Invesco, thank you. Equity futures right now in the S&P negative by 1/3% with an update on stories elsewhere. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. Recapping the latest economic data, PPI came in lower than expected, falling 0.5% in April. That's the biggest decline in 5 years. The median forecast in Bloomberg's survey of economists called for a 0.2% gain. Meanwhile, retail sales barely rose in April, suggesting consumers pulled back on spending amid tariff concerns. Meanwhile, President Trump says he asked Apple CEO Tim Cook to stop building plants in India. The comments threatening to throw a wrench in Apple's plans to import most U.S.-sold iPhones from India as it tries to diversify manufacturing beyond China. Trump said Apple would be upping their production in the U.S., but gave no further details. And in sports, the Minnesota Timberwolves are back in the Western Conference Finals for the first time since 2004 after beating the Golden State Warriors in 5 games. They'll be facing either Denver or Oklahoma City, and the Celtics battled back in their series against the Knicks, winning Game 5 with ease. The Knicks still hold the series edge, up 3-2. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Up next on the program, we'll set you up for the day ahead with equity futures. Just a little softer. We're down by 0.4%.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
The open about 36 minutes away. Equity futures negative here by 0.4% following a three-day winning streak on the S&P 500. The week ahead, the next 24 hours plus, looks like this. Today, President Trump in Abu Dhabi as his Middle East trip continues. Tomorrow, going into the weekend, UMich sentiment. Sneak peek of next week. Home Depot earnings on Tuesday. Wednesday, earnings from Target. Thursday, PPI data and another round of jobless claims. Joining us now, Anne-Marie on a road trip with the President of the United States. AMH, what are you looking out for later today?
Well, the president just touched down about an hour ago, Jonathan, in Abu Dhabi. What I'm looking out for is potentially this deal that the Trump administration has been weighing, and this would give Abu Dhabi this opportunity to purchase more. All this has been in the making. In March, I reported that Sheikh Tamim came to Washington, D.C. He had a meeting in the Oval Office with the president. Soon after that meeting, the Emiratis said that they would be willing to invest $1.4 trillion. But key to that investment is them getting their hands on those chips. They have a better chance with the Trump administration than they did with the Biden administration. But we're going to be looking out potentially for that deal to come to the finish line today.
The tan is getting darker and darker at every stop, Anne-Marie. I've noticed. You noticed the same thing?
100%. I was just looking at that.
Are they doing work out there?
I think that
she's just like sunbathing.
Yeah, it looks like a beautiful time.
It's 110 degrees.
What's going on? AMH, thank you. Appreciate it. Looking forward to your reporting throughout today and tomorrow too.
I was thinking the same thing.
Not a bad life, is
yeah,
it?
Sheila's getting a little tan.
Right.
Hair gotten a little curved.
Sun-kissed.
It's really nice. No, look, it's a really interesting tour, especially given the fact that it's his first international tour at a time where the Middle East really is the epicenter of the geopolitical scene, but also deals, more deals.
Oh my goodness, every single morning.
Another deal.
Trying to catch up with the news overnight this morning when I got up at 3 a.m. Just like a long list of deals.
Fire hose.
Up tomorrow, George Concavas of MUFG, Andrew Honhorse of Citi, Lisa Shannon of Morgan Stanley, Kelsey Barrow of JP Morgan. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Italian Open update for Bloomberg TV and radio from Tennis Channel. Coco Gauff kept her perfect record against Mia Andreeva intact as she closed out the Indian Wells champ in straight sets to reach the Final Four. The American becomes the youngest three-time semi-finalist in Rome since Martina Hingis in 1999. And don't forget, you can watch all the action live daily on Tennis Channel.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because people they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
All right, 30 minutes until the start of the cash trade. We are looking at futures in the red. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the state of the consumer. Retail sales barely rise in April, another sign of a pullback in spending. And placing their bets, Jamie Dimon says he wouldn't take a recession off the table, while Steve Cohen says he sees a 45% chance of a recession. And another deal in sight, oil drops as President Trump says the U.S. and Iran are inching closer to a nuclear agreement. Katie, what are you watching?
Well, it's still earnings season, so we have two movers on the earnings front. Walmart reported solid sales and earnings growth, but cautioned that tariffs and economic turbulence will eventually lead to price increases. You can see down a little bit pre-market. And then we have Deere lowering the bottom of its profit outlook range as tariff uncertainty weighs on demand, but currently up about 2% pre-market, Matt.
Yeah, interesting to see that Deere move. We're also watching an M&A deal. Dick's Sporting Goods will buy Foot Locker in a $2.4 billion bailout. That's an 86% premium to yesterday's closing price. Katie?
And just a few minutes ago, Jerome Powell said that the Federal Reserve is weighing changes to key parts of the framework that guides its monetary policy decisions.
In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting.
Joining us now is Bloomberg's international economics and policy correspondent, Michael McKee. And Mike, when you say the Fed's going to change its framework, I think a lot of people pay very close attention. What exactly is going on?
Yeah, it doesn't have any bearing on the current economy or monetary policy, but back in 2020, they adopted their new framework, which said because inflation had been so low and because the economy was growing strongly, we can let that continue and we can run the economy hot. And then we got the big inflation. And so there is obviously, looking back, some regret about that, and they're thinking we're gonna change that. They haven't figured out exactly how they're going to frame the new framework, but that's the process that's in motion right now. But basically, you can expect them to kind of go back to where they were before. We're trying to anticipate where the economy is going.
Interesting. So laying the groundwork there to reframe the framework. I also want to get your take on the data that we got this morning, because we got retail sales, we got PPI, we also got some manufacturing surveys as well. What stuck out to you?
Producer prices stuck out to me, and retail sales, because they both told a story of tariffs finally starting to hit the economy. Retail sales headline was up only 0.1%, but that was largely because we bought fewer cars, and we've discussed that, the pull forward there. But the control group, that is all the stuff you buy on a regular basis, goes directly into GDP, was down 0.2% during the month, and that was a surprise. The PPI falls by 0.5% on the headline, and the core ex-trade falls by 0.1% and goes from 3.45% on a year-over-year basis to 2.9%. That's a big drop. And what happens there is the trade part is wholesale and retail margins. And so it looks like companies were absorbing some of the tariff increases into their margins.
Well, that leads nicely to our discussion on Walmart. That is Bloomberg's Mike McKee, our international economics and policy correspondent. And let's get back to Walmart now, because it reported strong results, but you had the CEO warning basically that there are price increases to come. Joining us now at the desk is Bloomberg's Shelley Banjo. So, of course, it was a pretty solid quarter, but everyone is focused on the look ahead, and the look ahead seems to be that the dollar signs are going up.
Yeah, it was a real tone shift for Walmart, which came out in April saying we're absorbing the price increases. We're a big company, we can absorb all these things, and we think that we're going to be able to actually gain out of this by market share. Then you have them come on today and say, there's only so much we can absorb. There is actually a limit, and that they are going to already start seeing price increases starting pretty soon, and they expect to be able to raise prices, in the coming months.
We also had a deal, Dick's Sporting Goods taking out Foot Locker for a massive premium, right, to yesterday's closing share price. Are we going to start to see, you think, a lot more deals like this?
This is the second consumer-related deal that I think was tinged with tariffs. So the first one was Skechers going private, saying, you know what, we will better be able to manage our business out of the public spotlight. And so now you have Dick's buying Foot Locker. Foot Locker was struggling. They were both hit by tariffs, saying, we're stronger together than apart right now.
All right, Shelley, thanks very much. Shelley Banjo there talking to us about the consumer stories tied to the market. Here to break it all down is Charles Grom, Gordon Haskett, senior retail analyst. He has a buy rating on Walmart with a $105 price target and a buy rating on Dick's with a $250 price target. Let's kick it off, I think, with Walmart, because that is, good morning, Chuck, the big story for markets, really for the economy. What do you make of the earnings?
I think, looking back, the first quarter was very healthy for Walmart. And we think, frankly, for most of retail, the cadence throughout the quarter got better as we progressed. Pretty much known by the market at this point, with April being good. You had Easter shift, weather getting better. Overall profitability for Walmart was actually very good. Inventory's clean. So I think looking back, the first quarter was very good for Walmart.
It's interesting, Chuck, if you take a look at the details here, even though they did beat when it comes to several metrics, they had sales rise 4.5%. If you look at the details, you did have transaction growth slow. You also had grocery and pharmacy really holding up, whereas general merchandise seemed to slow here. Looking at those details, you could say this looks pretty worrisome when you think about the health of the consumer.
Yeah, I would say that if there is any blemish in the comp, to your point, it's a great point, that traffic on a 2-year basis did slow. If you sort of unpack the 4.5% comp and strip out e-com and strip out the benefits from GLP-1, you're looking at basically a flat comp. But general merchandise has been choppy for Walmart for quite some time. It did improve overall. Deflation did weigh on the category, and there was mixed results. I mean, apparel and toys did better. CE Home did worse. We'll hear from other retailers in the coming weeks, but our sense is that Walmart's number, that 4.5%, will be a bright spot when it's all said and done.
I want to ask about the deal, $2.4 billion, 86% premium for Foot Locker. Is this, are we going to start seeing a lot more deals like this as tariffs force these retailers to consider their options?
It's possible. You know, looking back historically, retail deals like this tend not to be that great. I mean, the one that comes to mind for me was when Dollar Tree purchased Family Dollar a decade ago, and as you know now, Dollar Tree is unwinding Family Dollar. So this deal, I think, comes as a little bit of a surprise. We're going to hop on the Dick's call as soon as I get off here to learn more about their strategy. But for a really solid company in Dick's Sporting Goods to buy really a mall-based retailer with a lot of international exposure, I think is a bit perplexing, and that's why Dick's stock is down about 10% pre-market right now.
Well, that's where I wanted to go, Chuck. And like you said, you're about to get on the call to find out a little bit more about the strategy. But one of your peers over at TD Cowen said that before the deal was formally announced that this would be a strategic mistake for Dick's. Basically, it'll leave them more exposed to streetwear and lifestyle fashion. They're also going to be competing with more nimble sneaker retailers. It sounds like you share some of those concerns.
Yeah, we do at this point, but we'll see what they say between 9 and 10 and go from there. But, you know, Dick's, you know, they were actually reported today, which is another sign of a healthy first quarter for the consumer, over a 4% comp, whereas Foot Locker reported a low single-digit decline. And I think that's sort of, you know, the concerns here is that Dick's has been executing near flawlessly. They're one of the few retailers that during COVID gained a lot of customers and actually have done a phenomenal job holding on to that customer base. So many companies we cover, whether it be Wayfair or Target, have really receded and given all those customers back. So this deal is definitely perplexing at this point in time.
And Chuck, broadening out, looking at your entire coverage universe, you have a lot more reporting companies in the weeks to come. You think about Costco, for example. We have BJ's slated as well as Target. When you think about Walmart's results this morning and those sort of worrisome details in that, the warnings about price increases, what can you extrapolate out to the rest of your coverage universe?
Yeah, that's a great question. I think EDLP is going to win today. It's going to win in the second quarter. It's going to win in the back half of the year. And I think companies like Costco and BJ's that have that lower price are going to win. Companies like Target on a basket basis are 10% higher than Walmart in our studies. That's concerning. The dollar stores are higher than Walmart. That's concerning. So I would lean favorable on companies that have those low prices and, by the way, a lower SKU count. I mean, one of the reasons Costco is so successful is they only sell about 3,800 SKUs. So if they see a price go higher in an item, they don't necessarily need to sell it. Whereas most retailers do. So we're very bullish on both the warehouse clubs and, frankly, you know, the Sam's Club numbers within Costco today, over a 6.5% comp, we're very good.
All right, Chuck, we're going to let you go get to that Dick's call. Really appreciate your time this morning. That is Chuck Grom of Gordon Haskett. Meanwhile, a quick check on futures right now. You have a move lower on the S&P 500. This would snap 3 straight days of gains. The S&P 500 off by about 0.3%, putting that fragile year-to-date gain in jeopardy. The NASDAQ 100 also a little bit lower. The small caps relatively unchanged right now, but the color is red. Meanwhile, Matt Miller, we do have some more movers on our radar. Cisco boosting its full-year revenue guidance. You can see the stock being boosted as well. And then CoreWeave, a recent IPO.
Yeah, absolutely. CoreWeave has been killing it up 60%, more than 60% since it went public. That was at the end of March. And you can see United Health down another 8%. This is a company that has seen its market cap cut in half this year, appointed a new CEO this week, pulled its guidance, and now we're learning that it's being probed by the Department of Justice over Medicare fraud. That, according to the Wall Street Journal, the company has said it has not heard from the Department of Justice and that it abides by all the rules.
Yeah, looking forward to more details there. But what a week to forget for United Health, and down another 8% pre-market. It'll be interesting to see how it settles up. Now, coming up, we're going to head to the Middle East, where President Trump is pushing for deals with Iran and India. And before we go to break, Bloomberg asked Jamie Dimon about his economic outlook. Here's what he had to say.
I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer is not here for that. As small businesses doing under $50 million, you know, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Let's get now to high interest, a look at what's making headlines around the world. A looming New Jersey Transit rail strike could upend the commutes of over 350,000 people a day starting tomorrow as engineers prepare for the first walkout in over 40 years. The engineers are seeking parity in pay with engineers at other commuter railroads in the area, like the Long Island Railroad. Meanwhile, New Jersey Transit officials maintain that they cannot afford to pay the increases the union is demanding. The agency is urging people to start working from home. And two New York Republicans, Nicole Malliotakis and Nick LaLota, are signaling that the cap on the state and local tax deduction may rise to as much as $80,000. The current $10,000 SALT cap expires at the end of the year, and lawmakers from high-tax states are demanding a boost in exchange for their votes on President Trump's tax package. Their support is critical. House Speaker Mike Johnson needs the support of nearly all Republicans in order to push the bill through the chamber. President Trump is suggesting the U.S. is closer to an agreement to curb Iran's nuclear activities. He spoke at a business event yesterday in Qatar.
Iran has sort of agreed to the terms. They're not going to make, I call it in a friendly way, nuclear dust. We're not going to be making any nuclear dust in Iran. And we've been strong. I want them to succeed. I want them to end up being a great country. So we'll see what happens. But we're in very serious negotiations with Iran.
The news of the potential agreement, meanwhile, is prompting a sell-off in oil. As you can see here, we're looking at a drop of 3% over the past couple of days. Joining us now from Abu Dhabi is Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. She is following President Trump on his Middle East trip. And Anne-Marie, what has exactly happened here? What has the president heard that makes him think we're closer to a deal with Iran?
Well, when the president was talking about this in Doha before he touched down right here in Abu Dhabi, he was saying, you might have seen the report. There was a report of a top advisor to the Ayatollah of Tehran saying they're ready to make an agreement with the United States. But Matt, they listed what that agreement for them would mean. They're willing to not have nuclear weapons, but they still want to enrich uranium and have a civil program. Basically, if you read that report, what they're outlining is the exact deal that Trump and his first administration pulled the United States out of, the JCPOA. Trump went on to say when he was talking about Iran, because he, of course, was in Doha saying how the emir wants him to really do a diplomatic deal. And Trump was talking about we could do this the intelligent way, a deal, or we could do this the brutal way. There, of course, is going to be a menu of options for this administration on how they want to deal with Iran and thwarting their nuclear capabilities. We should note that earlier in the week, Trump also talked about other grievances he has with Iran, not just enrichment of uranium, but also the fact that they financially, politically support the terrorist organizations in the region and the proxies when it comes to Lebanese Hezbollah, Hamas, and Houthis. So Trump once again put out an olive branch, but we should make clear what the Iranians were talking about in that NBC report is exactly the deal that Trump pulled out of when he was president as the 45th president.
And you're looking at live shots of President Donald Trump in Abu Dhabi right now. Anne-Marie, I want to talk a little bit about Apple because we got some interesting headlines from the president, some interesting sound bites saying that he talked to Tim Cook and basically asked them to stop building plants in India. He wants to see that production come back to the United States.
That's right. Second time this trip that the president has called out Tim Cook. The first time was on Tuesday in Riyadh. The president was looking out to the audience of investors and business executives and say, I see my friend there, Jensen Huang of NVIDIA. Tim Cook's not here, but you're here. And then in Doha, he was talking about India and the fact that India says they are ready to bring their tariff levels for zero, potentially lining up another trade agreement in principle with India. And then he said he just got off the phone yesterday with Tim Cook, and he was annoyed with Tim Cook because what we see from Apple is they're moving their production of iPhones from China to India. So Apple's looking at de-risking, moving their supply chain, but it doesn't seem to be enough for the president. He says, we don't want you doing this in India. We want you doing this in the United States.
All right, Anne-Marie, great reporting as always. That is Bloomberg's Anne-Marie Hordern reporting from Abu Dhabi. And the Apple story is really interesting to me, Matt, because for Apple, it would be so expensive to build these iPhones in the U.S. And we're talking about Apple here.
Right.
If they're having these problems and trying to ship to India, now being told that's not okay, you have to imagine there's hundreds and thousands of other countries facing or companies rather, facing these same problems.
On the other hand, you know, I have a 4-year-old daughter. I've been training her to work with a tiny little screwdriver.
That's great.
I'm hoping for that in her future.
Yeah.
All right. Great to get caught up on Trump's trip right now. Coming up, we begin the trading day with Citi's Stuart Kaiser. He is getting bullish on, wait for it.
Tell me.
Small caps.
Wow.
As well as technology, hardware, and home builders. This is Bloomberg Open Interest.
It's the most fascinating time for the global economy in years, and our conversations are front and centre.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Well, billionaire Steve Cohen says that the likelihood of a U.S. recession is pretty much a coin flip. The Point72 founder says there's a 45% chance of a recession right now, and that markets could drop another 10 to 15% in that case. He also said that that wouldn't be a calamity. Citigroup's head of U.S. equity trading strategy, Stuart Kaiser, joins us at the desk. And Stuart, so we heard from Stephen Cohen. We also heard from Jamie Dimon just in the past hour saying that he's not taking a recession off the table. I want to hear the Stuart Kaiser view of where we stand.
Look, honestly, I think clients are in the same camp. I think we've sort of broken into two pieces. There's a group of clients that say you're pulling back on fiscal, you've added a major uncertainty shock, and you've just increased global transaction costs, and that's the recipe for a recession. And I think some people are positioned for that. I agree it's kind of a coin flip. I think before last weekend, if I had to choose, I would have said recession more likely. After this weekend, I think what you're hoping you're going to see is that soft economic data and the survey data improve and hopefully kind of reduce those recession risks. But I agree, it's definitely not off the table, even if it's not, the most likely outcome right now.
What about earnings? We had gone from an expectation of 14% earnings growth this year, right after Trump's election, to now 8% earnings growth this year. How much does that bounce back up now that it looks like we're going to be getting a lot more deals?
I think it probably bounces back a little bit, Matt. And I think next quarter is going to be incredibly interesting because this quarter, 2/3 of S&P companies did not update guidance. They basically took a wait-and-see approach and punted on it. I don't think investors are going to be tolerant of that in 2Q. And I think a lot of these companies are going to really need to kind of sharpen up what their view on the tariff impact on their earnings is going to be. So you may see a little bit of an improvement off of what was kind of a worst-case outlook going into 1Q, but I wouldn't expect this to get back to 14%, for instance. So you're somewhere kind of in the lower end of that range.
Matt, you said something interesting there. It looks like we're going to see more deals. And Stuart, it certainly looked like that before, and we've had a lot of false dawns there. And in your view, do you see that actually coming to fruition, that we see a more acquisitive market?
More like M&A deals?
Yeah.
That's a good question.
Yeah, I meant Trump deals.
Oh, you meant Trump deals.
I thought you meant M&A
And I probably should have said, what I should have said is the deal, the one that we've seen thus far, was better than expected, right?
With China.
With China. And then maybe India on the way. But yeah, maybe we see more M&A deals as well.
Well, so I think, look, the M&A trade is very much an institutional investor risk sentiment trade. Our M&A target list is up 40% in the last 4 weeks. So the market is definitely trading like you are going to get, kind of the deal calendar opening up again. But to be fair, that also happened at the beginning of the year and it got completely derailed. So, will we see more M&A deals? We've seen 1 or 2 announced in the last week on the smaller side. side. The market is prepping to see them, but look, we need to see them happen first. But yeah, from a pricing perspective, it is starting to get priced.
I didn't mean to imply that M&A deals would be additive to earnings this year.
Yeah.
Or that M&A deals, big M&A, is ever additive to earnings.
Well, it is clear what investors want. They want more M&A and they want more trade deals. We'll see, of course, how that evolves. Stuart, you're sticking with us through the opening bell, and here is the setup as we await that ringing. You can see the S&P 500 losing its momentum after 3 straight days of gains, currently down about 0.4% pre-market. You have big tech leading that decline after leading the way up. The NASDAQ 100 down about 0.5% right now, and the small caps, they were unchanged, but now they're down about 0.2%. We are certainly going to talk about those little guys up next. The open is coming up. This is Bloomberg.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
All right, we have 25 seconds to go until the opening bell on this Thursday. This is Bloomberg Open Interest. I'm Matt Miller. We saw a slight gain at the end of the session yesterday for the S&P 500. Not quite to 5,900, but maybe we make it there today. It doesn't look like it right now. We're off 1/3% on futures. We're off 0.4% on NASDAQ futures. Small caps are down as well after we got news from retailers that maybe bodes better for the market than those numbers show. American Tower ringing the bell down at the New York Stock Exchange. If you have held this stock for the past 5 years, you're up 1.97%. So at least you're not down, right? At the NASDAQ, we've got eToro ringing the bell in a celebration of their decision to go public. and they brought a lot of people. All seem very happy about that. In terms of the stocks to watch, let's get over to Katie Greifeld. She's got a look at some of the big movers today.
Yeah, it's all about earnings today, and we start with Walmart, of course, now down about 3%. That's after it reported solid sales and earnings growth in the quarter just passed, but the focus is on that caution that tariffs and economic turbulence will eventually lead to price increases, perhaps starting this month, according to the CFO. Apparently, traders don't like that, but Deere actually having a positive reaction right now, up about 5%. That's after it actually lowered the bottom of its profit outlook range due to, you've heard this before, tariff uncertainty potentially weighing on demand, but still traders finding something to like in those shares, Matt.
Yeah, absolutely. So a couple of the big economic bellwethers, and we've got another deal in the shoe section. Dick's Sporting Goods will buy Foot Locker in a $2.4 billion deal. It's a massive premium to yesterday's close, 86%. You can see Foot Locker trading up to just about that, but Dick's getting absolutely decimated and then some, off 12% in the early trade. For more on the retail sector, joining us here at the desk again is Bloomberg's managing editor of global business, Shelley Banjo. And Shelley, it's really, I think, the Walmart story that economists would be paying close attention to, not the Foot Locker purchase. But what does it say to you, Walmart's earnings? Is the consumer still holding up?
I think the consumer's holding up okay, but Walmart is saying that they can't absorb prices forever. So they came out just a month ago saying we're big enough, we can withstand a lot of these things with the tariffs. We want to use this as an opportunity to gain market share. But now they're saying no longer, like we have to, there's a limit to what we can hold.
And the point is, a lot of the stuff that you get at Walmart is made in China.
Yeah, I mean, they'll tell you all about the things that they make in the U.S., but a lot of their stuff, particularly areas that were down, sporting goods, general merchandise, things like that, those are being hit by the higher prices.
And it's interesting within Walmart's results, and this is something we were talking about with Chuck Crom, that there was this very much a shift towards the staples. It was pharmacy, it was grocery that was really holding up, whereas general merchandise, it seems, was slowing down a little bit. I guess people aren't buying pool noodles necessarily, and you look ahead to what's still to come. Costco, Target, BJ's coming up in the next couple weeks. If Walmart is looking at price increases here, what are their peers thinking about?
Yeah, I think it's going to be worse for the rest of the lot. I mean, they had already been warning last quarter that things were not, started to prep their investors that things were not all going to be groovy there. And so now Walmart is saying, okay, things are not looking great for us going forward. We're going to have to start increasing prices. You will probably see that in spending numbers with consumers, pulling back a little bit. And so if that's what Walmart is saying, you can imagine what the likes of Home Depot and Target and the other companies are going to say.
All right, Shelley, thanks very much. Shelley Banjo there covers global companies for us. And we're back with Stuart Kaiser. It's interesting, the small caps, when I talk about all the stuff that comes from China at Walmart, I think the small caps must have a lot of China exposure as well. But why do you like small caps right now?
I mean, we like small caps very, very tactically. I mean, the fact is you've had this huge rally that was so narrow and gappy that a lot of investors weren't able to participate in it. So what they're looking for is, if I get this sort of next leg of the rally, what's lagged and what might catch up? And smaller cap, lower quality, kind of weaker credit risk type of equities and companies we think do have that potential. But again, that's a very tactical trade. It'd be very hard to recommend people get into, IWM or small cap over the medium term, given the, latent recession risks that are out there.
But that is the way you like to trade it. I mean, Katie's ears just perked up. What's the ETF? IWM?
IWM,
Yeah, that tracks the Russell 2000, which people like to tell us is a junkier sort of index. We were having a great conversation with Ron Temple, actually, the other day, of Lazard, who was saying basically what you're saying, that you have to be very, very active. There's a lot of security selection that goes on. You like to trade it tactically, but I have to ask, is the juice worth the squeeze? Because it sounds like a lot of work.
Yeah, I think that's an open question, I would say. I mean, if you can look within the Russell 2000, there's probably 700 of those 2,000 stocks that make money. So you do have the upper part of IWM is pretty high quality, and we do see some people doing stock picking in there. For a macro investor, you're just buying the whole index, and you're really hoping for either improving growth, lower rates, or just kind of a risk-on positioning squeeze. And I think right now it's much more on the positioning side that people are willing to engage in small cap. I think the difference now versus, let's say, December of 23 or last July is you had such a short base in small cap that you had a lot of squeeze risk to the upside. I'm not sure that positioning dynamic is in there. So to your point, risk reward is kind of a little questionable, and I think that's why it's had a little bit of trouble getting its footing.
You also like tech hardware, which is another one where I think, wait, isn't that stuff that's made in China as well?
Well, the China news is good, right?
Yeah.
So look, I would say that the three areas, weaker balance sheet and small cap, consumer durables, which has been right in the crosshairs of tariff risk, and tech hardware, are just three parts of the market that have lagged during the tariff headlines.
They've got punished a little too much.
Well, and if you're an investor who kind of missed some of this rally going, those are areas that might play some catch up. But again, those are like very tactical things. I think that's a 1 or 2 week trade. Bigger picture, we would be in growth stocks. And that's the area we're more comfortable kind of running medium-term equity risk right now.
Let's talk about growth stocks and specifically tech, because you think about the last few weeks for tech, they've led the rebound. And you take a look at the NASDAQ 100 specifically, it actually entered overbought territory on its relative strength index, I believe, yesterday. When you talk about being tactically, do you think that we might lose a little bit of momentum when it comes to this tech rebound?
It's possible, but look, like our growth factor is up 21 out of the last 30 trading days. I mean, this has been a very steady kind of clean trade to the upside. And the view here is in the beginning of the year, given all the uncertainty you had, you would have liked to have hidden in growth stocks. The problem was they were very, very expensive and they were very overowned. Both of those things went through a pretty, a painful correction in late February into March. So our view was after that correction, this is defensive again and you can hold it. To your point on the overbought, if you're starting to get back to that position, then you're kind of rewinding back to where we were in February. And maybe you do then have positioning and valuation risk. We don't think you're fully there yet. So we do think there's still more room for growth to work. But that's going to be the ultimate question. It's not the strength of their balance sheet. It's not their earnings growth. It is positioning and valuation that will get people to kind of fade that trade, I think.
And outside of trade, Matt, we should note that coming up is NVIDIA earnings on the 28th of May. So you think about catalysts here. Here's a big one.
Yeah, that's a huge one, I guess. I go back to that conversation we had with Ron Temple of Lazard. And one of the interesting points he made about small caps is that, as Katie points out, it's a lot more important to be active in small caps than it is, say, in the S&P 500, obviously. In times of volatility, is it better to be more active, right? We've seen this huge drawdown and now a bounce all the way back up. Or is it better to kind of keep your fingers away from the stove and just track the big index?
Look, I mean, in this case, as painful as it was probably better just to stay invested. We had a quick note over the weekend that the entire 17% rally, you could have captured in 60 trading minutes if you had just timed it perfectly. So in that sense, it was very hard to be tactical because you had to be so precise and surgical and right to catch it. And I think that's really what's really frustrated a lot of institutional investors is you rallied so hard off the bottom, but really if you didn't own a few little 15-minute intervals, you just weren't able to take advantage of it. So I think folks were trying to be tactical and trade the headlines. In this case, the degree of difficulty to being right was just really unattainable.
So is stay invested the lesson we learned? Because Ken Griffin was telling Shinali on Monday it would have been better to be in cash.
Look, it depends on your investor type and your holding period, right? I would say long-only investors, your sovereign wealth funds, your pensions, they were looking for opportunities to engage in the sell-off because they have a holding period that can endure that volatility. As you know from our hedge fund and macro directional investors just don't have the luxury to kind of buy and hold, and unfortunately that made this a really difficult trading environment for them.
Cool. Stuart, great to have you as always. Citi's Stuart Kaiser there talking to us about the stock market, and now Katie's going to take a look.
I'm going to do something
at the
special.
Stock market.
I'm going to take a walk and talk here. I want to break down this market and take a look at the breadth. We had very light breadth to the upside yesterday. Still managed to close in the green. Right now, you have the S&P 500 off by about 0.3%, and pretty much an even split when you take a look at what's gaining and what's losing, both to the upside and the downside. Let's look at specific stocks here. It's very much still earnings season, and you can see that in Cisco. This is your biggest contributor to the upside right now. They actually boosted their full year revenue view, which has been a rare sight to see in this earnings season. You also have JP Morgan higher as well. That's the upside. Take a look at the downside. This is why we're lower, and it's because Amazon is off by 2.6%. That is taking 6 points off the index. And then you have United Health's bad week continuing to get worse with that Wall Street Journal report about potential investigations here. You can see United Health down about 16%. And this is broadly what you're going to see if we take a look at the sector view as well. This even split on the sector level. Utilities up in the green right now, real estate and financials as well. Pretty defensive tilt all told. And then you take a look at the downside. We have healthcare, consumer discretionary, and energy off by about 1.4%. Now, coming up, we'll talk about CoreWeave, also in the earnings season. Profit missed estimates as it pulls forward its AI spend. We'll give you all the details next. This is Open Interest.
in case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
All right, it's time now for top calls. Some of the analyst action in focus this morning, and we start with Cisco, getting upgraded to a buy over at Wells Fargo on AI optimism. The company boosted its full-year revenue guidance. It also beat on estimates when it reported after the bell yesterday. You add it up together, and shares are higher by about 5%. Next up, we have Pinterest getting upgraded to a buy over at Wolfe Research. The analyst cites improving fundamentals and said that the valuation is highly reasonable, but shares pretty much unchanged right now. And finally, JetBlue getting downgraded over at Raymond James. The firm sees a more balanced risk-reward after it was upgraded last month. And Matt, currently the shares are down by more than 5%.
All right, JetBlue then taking a hit today. But I want to swap to tech right now. CoreWeave is bringing forward some spending to meet consumer needs that weighed on earnings in the previous quarter and suggests AI spending could be higher than anticipated. You can see those shares down about 5% now as well. Bloomberg Technology co-host Caroline Hyde has the detail on this stock, which actually has been killing it since the IPO, right? It's up about 60%.
You're right. And maybe that's why we see a bit of profit taking, because I have to say, top line growth, revenue, phenomenal. When you're seeing more than 400% growth, people like that. People like the talk about demand, the OpenAI contract signed, the signaling of another $4 billion contract, which they wouldn't name the buyer, but already Muffet-Nathanson saying, we're assuming it's Alphabet. This is a company that is therefore, though, having to spend to meet that demand. The spend, the CapEx guide of $20 to $23 billion just irks some. More broadly, when this is a highly levered business and already they've just done their IPO, they're going to have to sort of put investors' minds at rest as this CapEx is going to be fulfilled by ultimate demand coming from these players. They're going to be building out, they're going to reap the rewards, but it does dent profit in the here and now, and that's probably why you're seeing shares tick down a little bit. Their forecast for operating income is 140 to 170 million. The market won 190 million. Remember, this is actually still posting losses as a business.
I will point out, and I said this when they IPO'd, I'll say it again, one of the co-founders went to Haverford College, and there's not many of us. It's a very small Quaker school. So you're interviewing the CEO of CoreWeave later. You're
Is he the guy? Is it a different co-founder?
No, it's a different man, unfortunately.
Not Mike.
I am curious, though, what What will you focus on in that interview? When you take a look at these results, you take a look at the sell side reaction, what sticks out the most to you?
Well, I think we do need to ask him about vindicating the capital expenditure. We want to get a hint on who that ultimate purchaser of the last $4 billion was. I think what's going on in Saudi Arabia is going to be really interesting, though, as well. Remember, the fact that we're seeing more and more promises of generative AI, sophisticated chips being able to go to the UAE and to Saudi Arabia, we understand there's concerns about how much of a controlled environment those data centers are. What does Mike say about that? He's going to be the perfect person to say, look, you can stop China accessing overall the cloud compute or indeed the chips more directly. He's going to have such expertise.
eToro is another recent IPO.
Oh, IPOs are back.
And it's also kind of the new school of financial stocks. What do you make of it?
It's like a social media meets trading app, basically. You can follow people that you want to replicate.
Yeah, you can replicate their strategies.
Exactly, and whether it's in assets of stocks or in crypto. So we've got the founder, the co-CEO coming on a little bit later as well to talk about how they saw, I think, 20 times demand for the shares and they ultimately placed. We're seeing the shares rocket yesterday. Yes, they're pulling back a little bit today, but this is what it means for the rest of the market. eToro, of course, delayed during that ultimate April 2nd onwards anxiety around tariffs, but they came back. We now have Chime, another fintech, which at one point was worth $25 billion when it fundraised back in 2021. Will they be able to come to the market? They're anticipating early June for an IPO. Your friend over at Mountain,
Mark D.
I'm not talking about Ryan. I know you might be bezies with Ryan Reynolds too. He's the chief creative officer, but they're looking to tap the market, get about $1 billion valuation. We're starting to see this creek open of the IPO market. What's so interesting though is you've been watching CATL over in China.
Cattle, yeah.
This is literally the stereotypical eye of the storm geopolitical company. It is an EV battery maker supplied to Tesla, but a Chinese company that the Pentagon said overall was in some way related to the military and should be blacklisted. But Bank of America and JP Morgan are on that actual Hong Kong placing. It's going to be the biggest IPO of the year in the world. $4 billion it could raise. And again, demand off the charts. They're even saying, look, we can do Reg S. We don't need you retail US investors. We can avoid some of your regulatory.
Well, it'll be fascinating to see how that one goes. I will say when it comes to eToro, and it comes, of course, to CoreWeave. So you had eToro, they were upsized, their IPO. CoreWeave,
opposite.
Which, it was the opposite. They had to downsize. Of course, what did they go public? Early April, the end of March. Feels like the environment has just so drastically shifted when it comes to sentiment around IPOs.
But I also wonder, that was a very idiosyncratic story about generative AI and the demand. Do you remember when they came, we were all still talking about a bubble in AI infrastructure that Alibaba CEO was talking about?
DeepSeek fallout.
All of the Microsoft concerns they were pulling back on their data centers. That's be another key question for Mike in Trader is like, how much are they seeing Microsoft actually coming back and needing that compute with them? Because they said, look, Microsoft did pull back, but Microsoft in their earnings said, we're still undersupplied here in terms of data centers. So I think that they did have a tough time coming into the market, but as you say, up and to the right ever since, up more than 60%.
All right, Caroline, really looking forward to your program. Caroline Hyde, anchor of Bloomberg Technology. She's going to be speaking to the CEOs of CoreWeave, not the Haverford grad, but the other dude, and the CEO of eToro on Bloomberg Technology today at 11 a.m. Eastern, right after this program.
Now, coming up, a bombshell criminal probe into United Health is crushing the stock and weighing down the entire S&P 500. We'll give you the details next. This is Open Interest.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on what's going on with stocks. 22 minutes into the session, we're looking at red arrows after the solid close, I guess positive close yesterday, and really a solid first three sessions for the S&P 500. So even when we're down 0.5%, we're still at 58.67, which is better than a stick in the eye and still higher than what we saw on April 2nd, on the close on April 2nd. The NASDAQ down about 0.6%, as well as Katie said, we're really waiting for NVIDIA. It's still a couple of weeks until NVIDIA comes out with earnings. NYMEX crude is one we don't always reference here, but off another 2 1/3%. It's a 61.68, so not at the lows that we've seen this year, but really taking a dive after President Trump said Iran may make a deal. In terms of the stocks, a lot of earnings news here. Cisco, Deere, CoreWeave, and Walmart. Then United Health Group has been a huge weight, especially on the Dow Jones Industrial Average, where it was the heaviest stock on the index. Now the reports that they may be probed by the Department of Justice, really taking another 16% off of the stock, Katie, so a huge hit.
Yeah, let's talk a little bit more about that bombshell report. That coming from the Wall Street Journal, that United Health is under criminal investigation for possible Medicare fraud. Bloomberg U.S. healthcare reporter John Tozzi joins us now. So for their part, United Health said in a statement late Wednesday that the Department of Justice hasn't notified the company about the reported investigation. So there's still a lot of questions out there. But what do we know so far, John?
Yeah, so as you said, the Wall Street Journal reported last night that the company is under investigation for possible criminal Medicare fraud. That would be a new development. We know that there have been investigations on the civil side. There's a long-running civil case around their Medicare Advantage practices. This is an area where we've seen increasing enforcement from the government over the past few years around how insurers bill the Medicare system in their Medicare Advantage plans, which has been a big driver of growth for the industry until recently.
So United Health has said that they have not been notified by the Department of Justice of this supposed criminal investigation, and that they stand by the integrity of their Medicare Advantage program. So just to be clear, the company essentially denies that it's participated in any kind of fraud. But what would Medicare fraud look like? What are these allegations actually about?
Yeah, so the way this business works is that when you sign up for a Medicare Advantage plan from a private insurer, that plan gets a premium from the government to provide your Medicare benefits. So they get a monthly payment for all of your care. And that payment is adjusted based on how sick you are. If you have cancer or diabetes or other conditions, the government pays them more to take care of you because your expected costs will be higher. Now, that system has been the subject of a huge amount of controversy because of the way that insurance companies and medical clinics can record diagnoses. Right. You know, they have the incentive to sort of record all the diagnoses they can. They get paid more, and there are cases and allegations involving other companies that they have sort of inflated or exaggerated how sick their patients are to increase their payments. So that's the kind of activity that we are potentially
talking
involved.
about.
Yeah.
Right. Okay. Although, of course, they deny it, and we want to repeat that. John, thanks very much. I know you're going to continue, probably head back to your desk, hit the phones again, continue to report on this story. John Tozzi there on United Health.
I will just point out that United Health down 48% year to date. You take a look at the sectors year to date, and you can see that reflected because healthcare is now your worst performing sector in the S&P 500. Such a different outlook from where we stood at the beginning of 2025.
Yeah, interesting also because it's a defensive sector still today, and yesterday it really should have been getting gains. When we come back, we're going to talk to Liz Ann Saunders of Charles Schwab. Stay with us here on Open Interest.
Are you worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person not managing that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A new warning from Federal Reserve Chair Jerome Powell on what's to come in the months ahead as a result of uncertainty over President Trump's tariffs.
We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks.
He says longer-term interest rates are likely to go up. As for retail sales, the Commerce Department reports consumers spent just a little more, 0.1% in April. That's a sharp slowdown from 1.7% the month before. CBS's Emily Pandis.
People are waiting and seeing how tariff policy is going to impact their pocketbooks and impact prices before they go out and start buying things en masse.
If you're looking to buy a home, chances are prices are too darned high. A National Realtors Group confirms a nagging affordability gap.
The report says households earning $75,000 a year can only afford 21% of home listings.
Even though listings are up in some areas, they're often priced well above what most local households can afford.
Nadia Evangelou with the National Association of Realtors on where people can get the most for their buck.
Iowa, Indiana, Illinois, Ohio, and West Virginia are states where affordability is actually relatively healthy.
CBS's Matt Piper. The Supreme Court's hearing arguments on President Trump's push to stop lower courts from holding up his executive orders on things like birthright citizenship. Correspondent Jan Crawford.
Presidents in both parties, going back President Obama, President Biden, they also opposed nationwide injunctions because Republicans were going to judges in conservative states and getting them to enter their rulings that applied nationwide.
Ukraine's Vladimir Zelensky flew to Turkey today, but after meeting with President Erdogan in Ankara, he scrapped plans to attend peace talks in Istanbul over Vladimir Putin's decision not to show up. President Trump spoke in Qatar.
I just hope that Russia and Ukraine are able to do something because it has to stop.
Lawyers for Sean Combs have just begun cross-examining his ex-girlfriend at the rap mogul's racketeering and sex trafficking trial. Cassie Ventura spent 2 days on the witness stand, detailing years of alleged violence and manipulation. Attorney Judy Saunders specializes in sexual abuse cases.
They'll likely use photos and videos to show different times over the course of the relationship where they may have appeared to be happy and, put real question and doubt in the mind of the jury.
Dow down 166. This is CBS News. The internet's having a ball with HBO's reverse rebranding.
The move to return to HBO Max has been mocked on social media. One suggests bringing back the old HBO movie intro. Another imagines white smoke emerging from a Warner Brothers tower when the decision was made. Max got the message too, calling HBO a symbol of high quality, but also posting a line from its show True Detective.
Everything we've ever done or will do, we're going to do over and over and over again.
Steve Kathan, CBS News.
Controversy in Providence, Rhode Island, where officials have accepted a request to fly the Palestinian flag at City Hall tomorrow. They say they're doing it in the name of diversity, same as they've done to honor many ethnic and cultural backgrounds and traditions in the past. A city council spokesperson says no American flags will be displaced. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well. Alex Steele is out today. She's on assignment. Isabel Lee sitting in for Alex as well. Thank you so much for joining us for the next couple hours. We appreciate that. The president still in the Middle East. If he has any prepared remarks publicly, we're going to bring those to you this morning. We'll monitor that. We're going to check in with Anne-Marie Horburn from Bloomberg television correspondent. She is with the president in the Middle East. We'll get some reporting from Anne-Marie as that trip continues and the headlines flow from that trip. Nancy Daoud, private wealth advisor at Ameriprise Financial, is going to join us and talk to us about markets. We had a lot of economic data today. Michael McKee, Bloomberg International Economics and Policy Correspondent, is going to join us to break down some of the economic data. So we got a lot coming up here. We're going to have Lindsay Dutch, Bloomberg Intelligence Consumer Analyst, talking to us about Dick's Sporting Goods buying Foot Locker for a $2.4 billion deal. So a little bit of M&A as well coming up. So but right now, let's get a reset here. We'll go to John Tucker and get a Bloomberg Business Flash.
All right, and this Bloomberg Business Flash being brought to you by IBKR. Will U.S. oil production exceed 13.63 million barrels per day for March 2025? At IBKR forecast trader, the yes was recently at 12%. Let's start predicting today at ibkr.com/forecast. Now, the last trading day for this contract is May 29th. Major stock averages right now modestly lower. 5 of the 11 major industry groups in the S&P 500, they are down. The biggest drag, that's coming from energy. And then you had the biggest retailer, Walmart, saying tariffs and turbulence are going to lead to price increases starting this month. We're going to have a deeper dive in just a few minutes. It's the second worst performing stock in the Dow right now, which leads us to the worst performer in the Dow. That's United Health Group. Again, we'll have more coming up on that, according to the Wall Street Journal. Company under criminal investigation. Meantime, Cameron Dawson at New Edge Wealth expecting volatility to return.
We are seeing markets get slightly overbought, and we have valuations that are already back to 21.5 times forward earnings. This is a really fulsome valuation given the degree of uncertainty, the degree of earnings cuts that we're still seeing.
And Foot Locker stock, that's kicking it, Paul, as you mentioned, right now 82% higher. They're being acquired by Dick's Sporting Goods. Price tag there, $2.4 billion. That's a lot of sneakers. The economic data, Mike's going to be along in a few minutes to break this down, but I'll give you this one. Producer Price Index posting the largest drop in almost 5 years. That was a surprise. Why? With all the tariff news, slumping margins. Businesses, it looks like, are absorbing some of the cost of the higher tariffs. Right now, the S&P 500, 13 points lower. That's down 0.25%, 58.78 on the index. The Dow down 109 points. That's down about 0.25%. And the NASDAQ 100, 83 points lower, and that is down 0.4%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Isabel and Paul.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney with Isabel Lee, and we're joined by Bloomberg's Christine Aquino. Christine, what are you looking at today?
Have to look at United Health, Paul. I mean, that is the worst performer on the Dow, as John Tucker told us, and that is because of a Wall Street Journal report that the company is apparently under investigation for possible Medicare fraud. Now, the company did push back. They said in a statement on Wednesday that the Department of Justice had not notified them about the reported investigation. But remember, it's been a tough week already for United Health, so this is even more bad news for the company. Just on Tuesday, it sank more than 17% because the company abruptly replaced its CEO and suspended its 2025 guidance. And now we have a report of this investigation. Shares are down for 8 straight days, which is the longest streak since March 2024.
Wow. What about Cisco? They gave a solid forecast for their revenue.
That's right, Isabel. Cisco is a positive news story this morning. We're seeing shares now extending those opening gains up 6% higher or more, actually. And that's because of their solid forecast for the quarter that is slightly exceeding analyst expectations, according to Bloomberg estimates. And they're also getting a boost from corporations and cloud computing providers that have expanded their networks or are in the process of doing so. So that is an indication indication that Cisco is still benefiting from that AI play, even though some companies and data center operators may be paring back some projects. Cisco is still at the forefront of being a beneficiary of that.
I mean, market cap of $255 billion. I forget just how big Cisco is. Stock's up 5% today. It's up 9% this year, and on a trailing 12-month basis, up 30%. So it's getting a little bit of that AI love, it feels like.
Yeah, exactly. And good expansion as well from your typical AI names, right? And that shows you as well how this AI trade is rotating away from the chip providers and the chip makers to now kind of the periphery companies that are benefiting from other aspects of this, such as the data center story.
You think about 2023, 2024, all we talked about in the markets, it seemed like, was AI. And then tariffs came. And I feel like we haven't talked about AI really for the last 4 or 5 months, but it's still a story out there. And of course, we'll have NVIDIA reporting next week, and that'll bring it right back to the front burner. Walmart, what's happening in Arkansas?
Well, speaking of all we talk about is tariffs, I mean, very much related story there. Walmart down 3% at the moment, so pairing some of those opening losses there. We did get another solid quarter of sales and earnings growth, but it really is the company's outlook that is shaking up the investor sentiment. They are cautioning that tariffs, increasing economic turbulence means that it is expecting to raise prices, according to Chief Financial Officer John David Rainey, saying that if you've not already seen it, price hikes will happen in May, and then it will become more pronounced. And so keep in mind, of course, Walmart is just the opening salvo for retailers in the U.S. We have Home Depot and Target reporting next week, and so, or in the coming weeks. And so that begs the question as well, will these same retailers raise their prices as well? And what would that mean for the American consumer?
I mean, you see, I get Walmart can push through price increases, but how about the small retailer? What are they going to do when their prices, when their costs go up? How much can they pass through? I don't know. I mean, again, Walmart, Target, I get it. We've seen it before, but so many smaller retailers might have some margin problems. Christina Aquino, thank you so much for that report. Christina Aquino, managing editor for Markets Live, joining us live here in our Bloomberg Interactive Broker Studio. The president, of course, making a whirlwind trip through the Middle East. Lots of trade deals, announcements following the president's travels through the Mideast. Emery Horden's been there every step of the way. She is the chief political correspondent and a Bloomberg surveillance co-host. Emery, where are you today, and what's the news from where you are today?
I'm in Abu Dhabi. The president's been pretty quick to make sure he's hitting all the main stops in the Gulf. So Tuesday we were in Riyadh, and then we went on to Doha, and then this afternoon, morning in New York, he touched down in Doha, doing some cultural events, and then of course he's going to have a state dinner this evening with the president, Mohammed bin Zayed. It's the first time in more than a decade, almost 2 decades, where we've seen a U.S. president come to the United Arab Emirates. What we're really waiting on is whether or not we are going to see more of those deals. We've reported that likely, given the fact this administration has been weighing it, we could see the Emirates get their hands on more than 1 million chips, advanced chips from the likes of NVIDIA. And this comes on the heels in March when Sheikh Tahnoun, I reported, had this meeting with the president, and then they said they're willing to invest $1.4 trillion, but they need to get their hands on the technology first.
We have a Yardeni research note that says, from tariff man to global salesman, and really, we have one headline after another just about the trade deals that Trump has been making. Can you talk to us more about his singling out of Tim Cook and why that is the case?
Well, he started talking about India and how India is ready to lower their tariff barriers. This has been a long time coming, given the fact that we did see Prime Minister Modi be one of those first in line to go to the White House to see President Trump after he was inaugurated as the 47th president, and those discussions started immediately. So I wouldn't be surprised if we do get some sort of announcement during this 90-day reprieve that India has reached an agreement with the United States. But while the president was talking about India, he said that he had a difficult conversation. He's a little bit annoyed, it seems, with Tim Cook of Apple. He said he spoke to him yesterday, and he said, look, we don't want you building your plants in India. What we've seen Apple do is trying to de-risk out of China and move their supply chains, their manufacturing from China to India. And the president's saying, we want you to move that manufacturing to the United States. What is interesting is that throughout this entire trip, the president has been flanked by CEOs. He is viewing this entire trip through a lens of economic relationships, and that has to do with the private sector as well. On Tuesday in Riyadh, the president saw Jensen Huang of NVIDIA in the audience, said, "My friend Jensen's here. So excited you're here. I don't see Tim Cook here, but you are." And then today, while he was speaking in Doha before he touched down in Abu Dhabi, he once again called out Tim Cook. And obviously, he is notably a CEO that is absent on this world tour.
So anytime, Anne-Marie, that the head of the United States is in that part of the world, the Middle East, the discussion moves to Iran. President Trump is saying that the U.S. and Iran are closer to reaching a nuclear deal. What's the latest reporting on that?
Well, the president was talking about, you might have seen that report in NBC News when Iran was talking about what they are willing to do. And the president once again put out an olive branch. He did say we do this the intelligent way, AKA a diplomatic deal, or the brutal way, which would likely mean a strike on Iranian nuclear facilities. What we saw in the NBC News report, though, and this was a key top advisor to the Ayatollah sitting down with NBC News, what they outlined was that they would cede from going after a nuclear weapon, but they would still enrich uranium for a civil program. Basically, what they outlined was exactly what the president removed the United States from almost 7 days to the date. It was May 8th. In 2018, that the president decided that the U.S. would leave the JCPOA. So on the surface, what Iran is offering right now is exactly what the president, that deal that he left. The president has a very hard line that Tehran cannot get a nuclear weapon. But throughout this trip, he's also spoke about other grievances he has with the regime, which is their support of proxies in the region, like Lebanese Hezbollah, Hamas, and the Houthis. We have seen talks. There's been 4 rounds of talks between Tehran and Washington that's been mediated by the Omanis in Muscat. But at the moment, the president continues to put this olive branch out there.
Right.
But what Iran has offered in public is exactly what the president said 7 years ago he's unwilling to accept.
Anne-Marie, thank you so much for joining us. We really appreciate all your reporting during this trip. President Trump oversees some fantastic work. Anne-Marie Horder, Chief Political Correspondent, co-anchor of Bloomberg Surveillance, joining us remotely from Abu Dhabi, along with President Trump as he continues his trip today throughout the Mid-East. S&P 500 down 19 points. It's about 0.3%. The NASDAQ off about 150 points, 0.8%. So a little bit of a sell-off here. We got some economic data. We'll break it down with Michael McKee coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're being brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. After a three-day winning streak, stocks right now, they're lower. Declines being driven by retail, technology, and energy shares. And the NASDAQ 100 right now down 0.4%. That's being led by losses in Tesla, Meta Platforms, NVIDIA, and Palantir Technologies. Walmart falling after reporting a decline in the first quarter profit. Also warned it expects to raise prices due to higher costs from the tariffs. They didn't issue a profit outlook for the quarter. The shares down 3.4%. Dick's Sporting Goods reaching a $2.4 billion deal to acquire Foot Locker. Combining the two retailers, both of them, they've been pretty much beaten up by the tariffs. Foot Locker shares, they are up almost 83%. The United Health, the troubles keep it coming, tumbling on a report it's under criminal investigation for possible Medicare fraud. UNH shares down almost 17%. And then the largest seller of networking gear benefiting from demand for systems using AI technology, Cisco Systems advancing after the company gave a solid forecast for revenue. Right now, S&P 500 13 points lower. That's down 0.2%. 58.78 on the index. The Dow down 97 points. The NASDAQ 100 down 84 points. This caught my eye in the New York Post. Consider the source, but crime rates aboard cruise ships leaving the U.S. have reached a 2-year high.
Really?
They're citing data from the Department of Transportation. Allegations of 48 crimes were reported on board cruise ships from the beginning of the year to March 30th.
All right.
So
I don't know. I mean, guess
I'm actually surprised it's not higher. But
yes. We'll ask Charlie Pellet. He's our cruise correspondent.
Squeeze a bunch of people together.
Yeah, what
on
could
a
go
ship
with tons of alcohol,
with lots of booze,
what could go wrong?
Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Isabel and Paul.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. She is on assignment today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I think Alex is at like a refinery somewhere in like Louisiana or that's what she likes. That's her thing.
That's her version of a good time.
That's her version of
hanging out a refinery.
But I think it's the part of the country that's having like huge heat problems down there. I mean, crazy heat wave. But so where do you want to be? In a refinery. That's the place to be. But that's what she does. She's the energy maven there. So we appreciate her. And we'll get that reporting coming back. So anyway, we're here in New York and we're doing our thing here. I'm looking at a chart of the S&P 500. It's retraced most of the sell-off from that, near-term high back in February. So I guess it's another example of buy the dip. I don't know. Maybe let's talk to a professional who does this stuff for a living. Nancy Daoud, private wealth advisor at Ameriprise Financial. Nancy, with a little bit of hindsight here, is this proving to be a little bit of another buy the dip kind of scenario?
Well, sure. I mean, it wasn't very difficult to see that as soon as the tariffs went into effect, that there was a pure emotional reaction. It's not like we had data to back up this doom and gloom scenario. So it was a knee-jerk reaction and pure emotion. And of course, you always have the two opposite ends of the spectrum where people say, well, this is an opportunity. And the other end of the spectrum says this is doom and gloom and the world is going to end. Well, fast forward, not a very long time, just a couple of weeks. And here we are. We're right back to the starting point. The reality here is that we're still not out of the woods. The tariff will certainly have an effect, but we just don't have that information yet. So the lagging indicator is not going to show up until, the actual effects of the tariff on the U.S. economy are not going to show up for another at least several months. And so although we feel very optimistic, I think we should be cautiously optimistic because there's still some turbulence.
Have you then adjusted your recession probabilities? We have Steve Cohen, for instance, of 0.72 saying that recession risk in the U.S. stands at around 45%. We have Jamie Dimons, JP Morgan CEO, saying that it's still a possibility due to the tariff fallout.
You know, of course, it's hard to predict, but we believe that it's less likely to occur just based on the fundamentals. You know, there's narrative and then there's data. The data right now, everything points to strong. We had good earnings. We have good job reports. We have a solid U.S. economy, and inflation numbers are pretty good, that's been the buzzword for how many years now? For at least 2 to 3 years. So it's looking less and less likely, but that doesn't mean it won't happen. It's just less likely.
Fixed income, Nancy, how does that fit into kind of your model portfolio these days?
Well, we keep saying how fixed income has finally earned its name back. You know, it's been such a long time since there was no yield. Now the yield is very, very attractive. And what a great opportunity to diversify your portfolio and broaden the risk a little bit. To invest in longer term bonds and, you know, pick the most boring bonds or bond aggregates, which I would think would be the best option here because you're going to get a nice strong yield. And although the Fed didn't lower the rate the last time, they will eventually even if it's late, they will eventually lower the rates further, maybe a couple more times this year.
What kind of data are you looking at when you make decisions for your clients? We have Bank of America yesterday publishing this interesting chart that basically shows the gap between hard and soft data at their widest in 25 years. So it's really, I think, a confusing market. It's hardware to look for signals. Where do you find them?
Well, I think we always have to stick to the data because a lot of the soft data is based on emotion. And I would agree that it's about as polarized as could be right now. So always go back to, well, what does the data indicate? But as far as investor data, I mean, that's a very personal thing. It all has to do with the goals, their appetite for risk, and surely diversification should be in everybody's portfolio because then you hedge your bets a bit.
Nancy, thank you so much for joining us there. We always appreciate it. Nancy Daoud, a private wealth advisor for Ameriprise Financial. She's based down there in Miami, Florida, joining us via that Zoom thing. We had a lot of economic data today. We had retail sales. We had some inflation data from at the producer price level. We had initial jobless claims, a lot going on there. Let's check in with Michael McKee. He pays attention to this stuff. International economics and policy correspondent for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Hey, Mike, I look at retail sales. I want to get a sense of how the consumer's doing. The headline number, 0.1%, a little bit better than the consensus number, but a slowdown from last period. Then I look at something called the control group. I'm not sure what that is, but that was supposed to be positive 0.3%, and it was negative 0.2%. What did you take away from retail sales?
The consumer's definitely slowing down. You look at the control group number is the one that you want to pay attention to. They take out, the control group is basically the group of retail sales categories that go into GDP.
Okay.
They take out autos because the retail sales numbers are based on dollars, and the unit sales is what goes into GDP. Okay. So they take that out. They take out gasoline because when you're looking at the core, you know, gasoline goes up and down in price. That has the major issue. And they take out building materials because that shows up under the housing categories. So when you do all that, you end up with a decline of 0.2% in spending. And we were kind of expecting, given the lousy consumer sentiment numbers, that people would pull back at some point, and it looks like they started to do that.
What about, we have PPI, that decline was a shock. How do you square the two data then?
Actually, I think both are kind of related to tariffs. I mean, the tariffs and all that news is the major reason people cite for their lousy attitudes, and so they may have acted on that. When you look at PPI, a lot of it, most of the decline in the headline comes from services. Goods prices were unchanged, but services were down 0.7%. And a lot of that, most of that was in trade services. Now, you can look at the core rate that is PPI ex food, energy, and trade, month over month down 0.1%. But you look at the year over year, it went from 3.5% to 2.9% in 1 month, a big drop. And the reason for that is trade is not trade like ships and everything we've been talking about with everything going on with tariffs. It's margins for retailers and wholesalers. And so what that's telling us is that companies were accepting lower margins, and probably that was because they were accepting the business of paying for the tariffs in the meantime. That may change, but you see the tariff effect in both of those numbers.
So, Mike, I mean, we're hearing rhetoric from President Trump and his administration about walking back some of these tariff levels, most notably with China. But the fact is, net, today and going forward, our tariffs are multiples higher than where they were at the beginning of the year. Has somebody kind of cranked that into their model to say, what does that mean for GDP? What does that mean for inflation? Because it still feels like we're double-digit tariffs now versus low single digits before. That's got to have an impact.
Not only have they cranked it into their models, but they have cranked it and recranked it and recranked it as the president changes his mind. The latest feeling is that the odds of recession have dimmed, but growth is going to be very slow, somewhere between 0 and 1% for the year. And that we will see unemployment rise and we'll see inflation rise because of the tariffs. Now, you can't bet on that because the president still hasn't given us details on the tariffs. There's 2 different 90-day cooling off periods underway here. So we're waiting for all that kind of information, but the general view is that things are going to deteriorate. And so we've been waiting for that to show up in the hard data, which is starting to do now. We had the Empire and Philadelphia Fed regional manufacturing indexes, both of which were negative, but their prices paid numbers jumped significantly. The Empire one was the highest in more than 2 years at 59, and it was 59.8 for Philadelphia. So the inflation effect is starting to come into all of the data. So we should start to pick up speed on that as the month goes by and we get more and more numbers.
Yeah, and you know, the stock market has retraced much of its sell-off here, but boy, you still don't see any real move higher in the dollar. So that kind of gets everybody's attention here. So we'll see it in the data coming forward, and we will check in with Mike McKee when that data is released. Michael McKee joining us here, international economics and policy correspondent for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Coming up, Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines senior analyst on Dick's Sporting Goods, buying Foot Locker. We know those brands. And then also coming up, we're going to play some tape back from JP Morgan Chairman and CEO Jamie Dimon speaking to the Bloomberg Television's anchor Francine Lacroix. That's going to be coming up as well. So S&P 500 minus 22 points. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Stocks right now declining, yet mixed economic data. Shares of United Health Group diving on a report it faces a criminal probe. Walmart is falling as it warned of higher prices due to the tariffs. A worst performing group in the S&P 500, that's worth a look. Energy, we could actually see more supply because of the optimism of our possible deal between the U.S. and Iran. Mark Malik at Muriel Siebert & Company says also the tariff turmoil isn't over yet.
Stagflation has certainly been something we've been a little bit concerned about. Obviously, we've had some recent developments in these negotiations. However, if you look at the numbers, right, it seems like the president's still settling in somewhere around the 10% level for tariffs.
Right now, the S&P 500 down 17 points. The Dow down 116 points. NASDAQ 110 points lower. Most active Foot Locker, those shares were up 83%. Oh, by the way, the barista strike at Starbucks growing. Baristas at 100 unionized Starbucks locations have now walked off the job since Sunday with the company's new dress code. They have to wear tops. They have to wear black tops.
Black tops.
Everybody should wear a top.
Haven't they always just worn black tops?
No, it used to be like you could wear anything. And now it has to be black, and they figure they're going to pay for it. So anyway, that's the update.
There you go. All right, John Tucker, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele, who's on assignment today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming well on YouTube. A little M&A trade here. Dick's Sporting Goods to buy Foot Locker for $2.4 billion. I guess if you're a Foot Locker shareholder, you're pretty happy. Stock's up 84% here today. Not so much on the Dick's Sporting Goods side. That stock's down 15% here. Let's break it down with Lindsay Dutch, Consumer Hardlines senior analyst for Bloomberg Intelligence, joining us from Princeton. I remember when she was an associate. Now she's a senior analyst. How cool is that? Hey, Lindsay, talk to us about this deal. Why did it take place and why now?
Yeah, thanks, Paul, for having me. It is quite an interesting deal. As you mentioned, on the Foot Locker side, super positive. I mean, this company has been struggling to execute on a turnaround. Prelim same-store sales for first quarter down 2.6%, expectations for flattish. And then you have Dick's Sporting Goods, which has been outperforming the past couple of years, grabbing market share, sales better than expected in the first quarter. So from the Dick's side, there is some skepticism about, like, why are you doing this deal? And after thinking about it, I think there is a tremendous opportunity for Dick's in terms of growth prospects longer term. Their addressable market is going to more than double to $300 billion as they enter a global footprint, and they move slightly away from sport to grab that lifestyle customer, which they weren't really targeting before.
Could this deal tee up scrutiny at the FTC? I mean, they both sell sneakers, but some make the case that they're same but different because they really have different markets.
Well, fortunately, I talked to our antitrust expert, Jen Rhee, a little bit earlier today, and she is not too concerned here about FTC pushing back on this deal. A couple of reasons why. One, Dick's retail footprint is pretty small, 800 stores across the U.S. Foot Locker's is obviously much bigger, but the concern would come if market share in an individual market is sort of too high with the combination. Given the FTC right now, she thinks that store divestitures would easily satisfy any concern, but she thinks that concern might be minimal at this point.
Dick's Sporting Goods stock down 15% here. Talk to us about valuation here. Is the market saying, hey, maybe you guys overpaid here?
So I don't think it's an overpay. So they're buying Foot Locker for 0.3 times price to sales with that $2.4 billion valuation on the deal. That's quite low for the opportunity that they could get. I think the real concern is the two businesses are moving in opposite trajectories. So, Dick's, again, outperforming, grabbing that customer with their focus on sport. And this deal is contrast with that. Foot Locker is more of a lifestyle focus. They have a higher exposure to a lower income consumer. That has been part of their challenges. They also, gets 60% about of their inventory is Nike. So it is a different shift in the business. Foot Locker is seeing those same-store sales continue to decline, and that's really a contrast. So there's skepticism about that. Dick's has, though, executed its own turnaround in the past couple of years. So we see these long-term growth prospects as worth that 0.3 price-to-sales multiple, and that Dick's will now have to prove that they can turn around another business.
Lindsay, real quick, just give us a refresh on what the tariff situation is in that business, because I'm thinking it's really high.
So the exposure to China might be lower than you'd think. We don't have the disclosure on specifics from Dick's, but it's relatively low, imports coming from China, and it's mostly focused on their hard lines, like sports equipment business. For shoes, a lot of that is coming out of Vietnam. So yes, we're going to see higher prices likely with the higher tariffs, maybe on that 10% rate as of right now. So there is a headwind of that. But we think for some of those national brands, that price increase is going to just get directly passed through to the consumer.
Great. All right, Lindsay, thank you so much. We appreciate it. Lindsay Dutch, she's a consumer hardlines senior analyst for Bloomberg Intelligence, joining us from Princeton, New Jersey. Well, today, JP Morgan Chase CEO Jamie Dimon, he spoke exclusively to Bloomberg's Francine Lacroix at JP Morgan's annual Global Markets Conference in Paris today. Let's listen in to that conversation.
Hey, there's a lot going on. It's trade wars, markets up and down. What did you learn in the last month?
Not much. Other than we have all this uncertainty. Some preceded the new administration, like we had large deficits, interest rates going up, inflation going up, and some are, tariffs and things. And of course, the geopolitical situation is very tense, very difficult, and hard to resolve.
Okay, so if you forget projections, numbers, what's your hunch? Is the U.S. going to go into recession or not?
Look, I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
If you look at, the trade war and then the somewhat reconciliation between the U.S. and China, does it hold?
I think it's the right thing to do is to back off of some of that stuff, to have an engaging conversation. I'm grateful they did the U.S.-UK deal. It's an agreement in principle, so, there's a lot of uncertainty still. And there's a lot of uncertainty still in the China thing, but at least we started. It obviously calms down the markets. That's not the reason to do it, but the markets, do vote and something like that, and so you'll still have uncertainty to resolve. There's 90-day triggers in a lot of these things, and hopefully they will be resolved. But they're complex. I don't expect immediate resolution, to the satisfaction of everybody in 90 days.
But you expect markets to settle from here because we have a little bit more of a blueprint, or could volatility pick back up in any second?
Markets are quite unpredictable. I think there's a lot of uncertainty out there that you can't discount. War in Ukraine, terrorism in the Middle East, Iran, huge deficits, our tax bill, which I would like to see a good tax bill passed. The tariffs, the reaction of countries to tariffs. The EU and the UK are about to negotiate, and I think they have a chance to actually develop a great relationship, partially making up for, the disaster that Brexit became. And so, yeah, those are uncertainties. You can't eliminate them because you want to.
But what are your biggest clients saying about this market volatility? Have they made money on the back of it?
Yeah, some do and some don't. And, volatility could be good or bad depending on, who's facing it. So, but I would expect continued volatility. I think it's a mistake to think we can go through all the things we're going through and the volatility itself will come down.
Has it been good for JP Morgan? What's your, trading revenue looking like?
Yes, because when there's volatility, this is a very simplistic way to look at it. Spreads gap out and traders make more money if there's more volume. So we had both this time, more volatility, more volume. But very often when you have a lot of volatility and spreads gap out, there's much less volume. So you've seen examples where there's good volatility and there's bad volatility. This one happened to be good. The next go around may not be so good.
Jamie, when it comes to financials, I mean, a lot of, non-bank entrants are making quite a lot of way. Citadel, Jane Street. Is that a concern for the banks? Should it be a problem for the banks?
I wouldn't call it a problem. They're both clients and very capable. But I've always had the view there are a lot of competitors out there, and all the major banks are back. I think that's a good thing for the world, maybe not so much for J.P. Morgan. It is a divine right to succeed either. We've slowed ourselves down with regulation, stupid bureaucracy. We haven't done budgets in years. So we shouldn't assume it's forever. I don't think we'll still be preeminent, militarily and economically for a long time. But if we don't do everything right, we could lose that too. 20, 30, 40 years from now. And I think very important that is America. The goal of America should be to help the military alliances of the Western world and to help the economic alliance of the Western world to walk side by side like you did in Victory in Europe Day the other day here, to strengthen the Western world and hold it together, not to cause it to fragment. And so I think we have to work hard to make sure that's the case.
Do you worry about the deficits, and do you worry actually in the U.S., and do you worry also about the U.S. dollar remaining as a reserve currency? Do you think Europe has what it takes to try and put the euro in there?
Yeah, so I should have mentioned deficits up front as being one of the issues you have to deal with. And I think asset prices are quite high too, and those create various risks for America. Our deficit is almost $2 trillion, 6 or 7% of GDP, the largest peacetime deficit ever, and we have 100% debt to GDP. That 100% debt to GDP is kind of universal, almost around Europe on average, but your deficits are much smaller. Does that create a risk? Absolutely. It creates a risk of inflation to me. It creates a risk of higher long-term rates. But America, will the dollar get weak? I don't know. That's a slightly different thing. I think you could see rates go up, the long bond rates go up, and that might slow down the growth, and that's how we kind of a stagflation kind of scenario.
What do you tell? I mean, you must see President Trump regularly. What do you tell? What would you tell him?
I talked to all of the folks there. I wrote about my chairman's letter. I mean, first of all, America should worry about things we can do better. I call it blue tape. I mean, we are out of control. We're doing the same stuff that they did here that, virtually, the American public may not know. The GDP per person in Europe has gone from something like 90% of Americans to 65%. And they did it to themselves. Rules, regulations, overcomplication. They started the European Union, which I think is a huge accomplishment of mankind. They got to finish it. And here they call it the Capital Markets Union, the Banking Union. They have to create a big common market of 450 million people. And so in America, it's the same thing. It's regulations, it's permitting. We've wasted a lot of money in the green economy. It's getting jobs back. It's training in schools. It's fixing immigration. So we've stopped at the border, but now we have to have a more merit-based immigration, more seasonal immigration. Things that can help the country grow. And then we have to work on our military alliances, on our economic alliances, and that's for the sake of the future free and democratic world.
But so on the economic alliances, is there a concern that actually certain countries in Europe or elsewhere will choose non-U.S. bank for bond issuances, will choose non-U.S. asset managers to manage their pensions?
Yeah, there'll be a little of that. We irritate a lot of people. So I run into them. They say, like they're not buying our, Kentucky bourbon or something like that. There'll be some of that. And I think it's perfectly reasonable for, I spoke to a lot of investors here. They're thinking about the asset allocation to the United States. Will they diminish that? Possibly. Is America a bad investment destination? No. If you were to take all of your money and put it in one country, it would still be America. I mean, it's still the most prosperous nation on the planet. It's got the best military on the planet. It's got huge amounts of innovation. People are catching up. That's a good thing. China's doing some very good innovation in medical and AI, and we should assume they're going to continue to do that. But America's still got the best. Our GDP per person is $85,000. China's $15,000. We don't have anything to be ashamed about. We should fix our problems because we could grow a lot faster, which help all of our citizens.
But if you put out too many tariffs and actually too much uncertainty, does that not squander actually a lot of the assets that the U.S. has?
A little bit. I mean, I think they're doing the right thing now, which is to back off of it. Let the Secretary of Treasury do the hard work of figuring out what's the right thing to do. If there are unfair trade things, do something about it. But they have backed off of specific things in specific industries, and I think that's the right thing to do. I think the first thing was very large, that everything, everywhere, all at once, and now they're, kind of backing to where I think they should be.
In terms
but even at this level, it causes that kind of uncertainty. Even at this level, you see people holding back on investment and thinking through what they want to do, thinking about, how much you're going to put in the United States. And, I mean, we're going to be okay, but it is causing that uncertainty.
We were looking at the president, of course, in the Middle East, where there were deals that were signed and a lot of Wall Street, some of your competitors there. What's your strategy for the Middle East? How much do you want to grow there?
Well, we grow everywhere. I mean, we go country by country. We look at, we bank countries, cities, schools, states, hospitals, big companies everywhere. We have a network effect. So when we bank Bloomberg, we're banking you in the United States, we're banking you in London, we're in Paris, we're banking you in Europe, we're banking you in the Middle East. That's what we do. So almost every one of those countries, we're growing. As they grow, we grow. We cover, more of their institutions. Overseas, we're institutional. In the United States, we also have consumer. And so, as you know, we're testing consumer in Chase UK. So,
yeah, and you're growing, actually, that retail business a lot in the UK. What's next for that?
We hope to grow it more in the UK, add some products, and eventually, we've already announced we're going to go to Germany. I think we have a chance to build a great digital bank, and we have competitive advantages. We have a brand, we have research, we have a balance sheet, we've got capabilities. We're going to add, we're not going to announce it today, we're going to add more capabilities over time, so that, and then someone like you, if you travel to the United States and to the UK, you're going to be able to move your money between Chase US and Chase UK on your phone. So we're going to add things that make your life better as a consumer of our banking product.
You certainly caught some waves in talking about return to the office. I think there might have been a little bit swearing.
I emoted a little bit,
in there, or not? Have people listened?
Yeah. Yeah.
Has your staff come back full time?
Listen, first of all, I did emote there. I emote, people know me, and I don't really care about that. I don't worry about it. But I want to answer, the guy asked a legitimate question. And I gave it a very detailed answer about why it doesn't work for young people, why it doesn't work for management, why it doesn't work for innovation. I completely applaud your right to not to want to go to the office every day. But you're not going to tell J.P. Morgan what to do. And I think we already have 10% of jobs at home. I'm not against work from home. I'm against work from home that doesn't work. And then, of course, the press made a big deal about the petition and all that. It was like not even a mosquito.
Okay.
Most people are back. Some people, we've had no additional attrition. We had to make some modifications. We didn't have enough seats in certain areas, and we'll be a better company. And I think our employees will be happier over time. And the younger people learn the right way. It's an apprenticeship system, and you can't learn working from your basement.
That was JP Morgan Chase CEO Jamie Dimon speaking with Bloomberg's Francine Lacroix at JP Morgan's annual Global Markets Conference in Paris. A wide-ranging discussion. All right. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now. S&P 500 off 10 points, NASDAQ off 113. Let's go right to John Tucker, kick this hour off and get a Bloomberg Business Flash, John.
All right, just because I'm gloomy, let's start with the worst performing stock of the S&P 500 and the Dow, for that matter. I kind of feel like I'm repeating myself from earlier this week. United Health sinking. You had that report in the Journal this morning, a report of a criminal probe, just adding to all the problems that they felt that they're having. United Health shares right now 17% lower at 255.51 for United Health. Remember, one of their executives was murdered on the streets of Manhattan in December, and all the sympathy went to the guy who's allegedly shot him. You know, you have some reputational problems with something like that. Walmart stock, that's falling after warning price increases are coming. Dick's Sporting Goods buying Foot Locker, the price tag there, $2.4 billion. That has Foot Locker surging today. Shares of Foot Locker up close to 85%. Barbara Doran at DB8 Capital Partners says, you know what, the tariff uncertainty, that is still looming large over what has become an expensive stock market.
A 21 PE, we're back to that, up from 18 times just a month ago. So I think the market takes a pause. And I think with the uncertain, people are taking their eye off the ball in terms of the trade tariffs are still there. And right now, the blended rate is probably about 17.8%.
And right now, the S&P 500 to 11 points lower. That's down 0.2%, 58.81 on the index. The Dow Jones Industrial Average, 74 points lower. That's down 0.2. The NASDAQ 100, 67 points lower, down 0.3%. Yields are falling. The 2-year is down to 398. That's down 6 basis points. The 10-year, the benchmark, down 7 basis points, and that is at 446. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Isabel and Paul.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. She's down in some oil refinery somewhere on the Gulf Coast having fun. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney with Isabel Lee, and we're joined by Bloomberg's Christine Aquino.
Hi there, Paul. Well, let's talk about Steris, shall we? Because that stock is rocketing today. That's up more than 8% at the moment. And, it's a provider of infection prevention products. They just reported their earnings for the fourth quarter. Life sciences revenue, that was really the headline there. That beat average estimates. And Piper Sandler analysts are noting that its operating margin and earnings finished on a high note. Also, the fact that its full-year guidance for 2026 is bracketing street estimates shows that's a nice starting point for its ability to absorb the impact of tariffs.
What about Deere? This stock is also surging.
Yeah, it is, Isabel. So that's extending earlier gains. It's now up nearly 5%, so doing well today. We don't talk about this much because, it's a maker of tractors for farms. That's not particularly eye-catching on any other day, but today it is because it surged to a record. Its earnings beat the highest of analyst estimates. It did, however, trim its profit outlook for the year. As we know, the farm economy has been challenged. Tractor sales have been trending lower, but most investors are expecting the market to bottom out this year and a rebound in 2026. It looks like Deere is perfectly positioned to capitalize on that.
All right, what else you got for us?
Looking at T-Mobile as well, that stock is up nearly 3%, up 2.8% at the moment. And it's getting some good news from overseas, actually, because it operates at Deutsche Telekom over in Germany. And that company reported first quarter profit that topped estimates, which really is seen as a sign of resilience in its home market. It also raised its EBITDA forecast for the year, which reflects a similar move by T-Mobile in the U.S. when it reported its own results for the first quarter last month.
Are any of you T-Mobile users?
I used to be, but now I'm Verizon.
You're Verizon.
I'm Verizon too.
I'm Verizon. JT?
I have to check. I'm not really sure. No,
Do you have
Verizon.
a cell phone?
Yes, I do have a phone. It is confirmed. I got rid of the BlackBerry.
Okay.
Verizon.
Very good. All right, there you go. But T-Mobile, a lot of people. Charlie Pellet is a T-Mobile user and swears by it.
I mean, it's really, I don't see any difference. It's frictionless for me as long as I get to keep my mobile. I used to be T-Mobile, but then the head of the family said, let's move. I was like, sure.
Very good. All right. Yeah, speaking of head of the families, we are Verizon people. For more conversations like this, subscribe to our new Stock Movers reports. Listen to 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Let's check in with Mari Shore. She's a senior equity analyst at Columbia Threadneedle. She's up in Boston. We love to talk to her when we get the retail sales numbers, because she really spends a lot of time looking at the retailers, the consumer, that kind of thing. So a real helpful voice to us. Mari, what did you make of the retail sales here? I mean, I guess there's some noise here about, tariffs, and did that impact kind of how consumers are spending money these days? What did you make of the retail sales number today?
Yes, thanks, Paul and Isabel. Thank you for having me. Absolutely, you said it better than I could have. The tariffs are definitely creating some monthly noise. When we look year over year, the growth has been a little more consistent and actually showed acceleration in April versus March. But on a month over month basis, we did see softness in April versus March, given the pull forward that we saw in March ahead of some tariff-driven price increases that the consumer anticipated in some big ticket categories like autos. When I look and really step back and just getting off of Walmart's earnings call, I think their tone on the consumer is very consistent. Obviously, tariffs are creating a lot of noise in the spending trends, but in their words, the consumer is still very focused on value and speed of delivery. And that is what we've been seeing for years now coming out of the pandemic.
I'm glad you brought up consumer, because for Walmart, we saw traffic, which is the number of shoppers, less of a boost to the figure than ticket. What does that tell you? Yes. That maybe there are less shoppers, but they're buying more expensive things, or at least higher amounts of tickets?
Well, right. So that could either say they're coming in less frequently, and when they are in, they're buying a lot more, right? They're stocking up more, or to your point, they're buying more expensive things. But we did see relative weakness in their general merchandise category. We saw their, food category is up mid-single digits. Health and wellness was up high teens. A lot of that is GLP-1s. And general merchandise for them was actually down slightly, which is worse than what we saw in Q4. And so I think it suggests that the consumer is, coming to Walmart for their stock up trip, which is typically what we've seen with Walmart. But, I think a lot of that intra-week spend, those fill-in trips that we talk about, I think that the consumer may be doing less of that, just given their general caution and uncertainty over what tariffs are going to do to their spending ability in the future.
Hey, Mari, when you speak to the retailers that you talk to across your coverage area, what's the feeling today in terms of how much they want to pass through to customers versus how much they're willing to kind of take in their margin here?
Yeah, it's a great question. And it's so interesting seeing the commentary from the retailers versus what we see in the stock market is very different, right? I mean, the stock market is acting as if these tariffs are no big deal. We got some resolution, things are going to be fine. Then you listen to the retailers. I mean, you listen to Walmart today. They're talking about, starting now, there will be less product on shelves. They're going to do all they can to try to protect pricing and their value position in faster turn categories like food, but there's certain categories like toys, electronics, even some of the textile categories like apparel and soft home, where it's going to be really hard for them to absorb the full impact of tariffs. So I think, the 10% rate for a lot of companies is a lot more manageable. When you talk to them about the 10% we see globally ex-China, they seem to feel a little bit better about that. I think, the 30% in China is still too high. And the margin levels in a lot of the categories that come out of China are very low, and they just do not have the ability to absorb that pricing themselves, share it with their vendors or their vendor partners, their manufacturing partners, who are also operating on very low margin. And so it's inevitable that some of that is going to have to come through to higher prices. It's just a question of, I think what the retailers are really they're really struggling with now, how to think about that trade-off between price and volume. During the pandemic, as everyone took pricing, we did not see the kind of elasticity of demand that you would typically expect to see when prices move up. And I think how the retailers manage their unit inventories is going to be a huge area of focus for them and for investors during this really volatile period.
One thing that also caught my eye with Walmart is it said its online business posted a quarterly profit for the first time. Are you seeing the same trend across the board, and what does that tell you?
No, this is very Walmart specific. We have seen in the e-commerce space, Amazon and Walmart taking incredible share. And so when you listen to Walmart, and they've been kind of alluding to the fact that they were nearing this inflection in profitability for some time, I think it's really coming from two things. It's coming from the scale that they are now seeing as that business has grown so much. And also they've talked about how consumers are increasingly willing to pay for delivery, for expedited shipments. So if you're making dinner tonight and you realize you forgot a certain spice, you could pay $5 to have Walmart deliver it to you in the next hour. And in those cases, the consumer is more willing to pay for delivery. And I think that's something Walmart had not expected. But it is a key, I think, part of the reason why they are able to achieve e-commerce profitability. They also have, of course, the benefit of the growth in the marketplace and advertising and fulfillment services and membership, all of which are higher margin and are really starting to move the needle for them, as we see with Amazon. But I think Walmart and Amazon are in a league of their own as it relates to what they're seeing in e-commerce, both in terms of the growth that they're putting up in that business and the profitability that they're able to achieve.
Mari, thank you so much for joining us. As always, Mari Shore, Senior Equity Analyst for Columbia Threadneedle Investments. She's up there in Boston, and she joined us via that Zoom thing. What I learned from our next guest years ago, which shocked me and still to this day amazes me, the largest supermarket chain in the United States is Walmart. I never would have guessed that. And now that I think about it, of course it is. Jen Bartashes, she's the one that kind of enlightened me on that one. She's Bloomberg Intelligence Senior Analyst. She covers the retail staples and the packaged goods companies. So, Jen, I'm thinking in a world of tariffs, and I'm worried about, if I'm a retail investor, kind of the margins my retailers like a Walmart might have. Having the grocery store business as a traffic driver, that's got to be a good thing. Did we see that in Walmart's numbers today?
Yeah, hi, Paul. We absolutely saw that in Walmart's numbers. Their growth in consumables and grocery, mid-single digit growth, that means people keep coming back to Walmart to buy their staples. And that's a foundational type of thing, because for Walmart, as they get these customers doing that regular repeat shopping and coming in consistently, it really bodes well for how well they'll be able to retain those customers once all of this market volatility fades, and people become a little less price sensitive.
How does Walmart just really in general raise the pressure for competitors? We have Home Depot and Target reporting out soon. How do you think they will fare?
Well, I think that Walmart is really uniquely positioned because it arguably has the best view into mainstream America consumer of any retailer out there, because they touch such a huge number of households. And so when somebody the size of Walmart says that even their scale isn't big enough to fully offset tariffs, the read through on that is for other retailers who are smaller and who have bigger exposure to imported goods is rather dire, because Walmart is the one that is probably best positioned to weather it because of its scale. But that just means for the smaller guys, it's going to be a really difficult battle, and that there's going to be a lot more price that has to be taken and a lot more operational maneuvering to try to stay competitive in that particular set. So Target has a lot of discretionary exposure. Home Depot, Lowe's, they both do as well. So it could be a difficult season for those retailers.
All right, full disclosure, and John Tucker knows this. My last job in this illustrious career of mine will be as a greeter at Walmart.
We hope to see you
That
there.
would be fun. I'll visit Walmart.
I've never been in one because they don't have them near me. It's weird.
Route 70 in Brick. That's going to be
That's too far.
The next stop here on this one. Hey, Jen, you mentioned it, and that's kind of where I wanted to go. I can see Walmart dealing with higher tariffs and pricing because they're Walmart. But how about the mom and pop retailers out there on Main Street USA? How tough is it going to be for them, do you think?
It's incredibly tough, Paul, because the mom and pop retailers, it's usually only a handful of employees. It's a very set type of inventory that they carry. They don't necessarily have the ability to flex in and out of different product categories to lessen the impact of tariffs, because they're usually known for a particular type of product, which is why their customers come to them. And so, they're very reliant also on getting goods either directly or through third parties that are imported. And so there's just very little room in their operations to be able to offset the power of what's come, or the pricing that's going to come with these tariffs. And we've heard anecdotally small businesses that are just saying they've had to lay off employees already. There could be greater ramifications, in terms of unemployment and things if small businesses are impacted to a large degree, should this tariff situation persist for longer than we're expecting.
Yeah, you bring up a good point, because you have CFO John David Rainey saying the range of outcomes is pretty, quote, extreme, and it is. How has Walmart, have they hinted on how they're preparing for it? I mean, we know that they're a good barometer of the U.S. economy, and they're really, really huge, but they must still be impacted by tariffs.
Absolutely. They definitely will be impacted. But part of where their advantage is that the company has been investing for some time behind technology like AI. And AI has across retail, but especially for those retailers who have had the time and the balance sheet to invest in it, gives them a lot of flexibility in their tools for predicting what their need is going to be and for responding quickly to changes in their supply chain. So, that investment in AI will actually pay some dividends and probably help them navigate the tariff situation more easily. And again, that goes back to the smaller players who don't have that kind of technology support or haven't been able to make those investments. It will be harder for them to maneuver in that environment.
So, Jen, if I'm Kroger or some big, grocery store, and I don't know, Kraft Food comes in and says Cheese Whiz is going to be 10 or 15% higher price to you, Kroger, because of tariffs. How does that conversation go? Who's got the leverage there? Who eats it? Who takes it? How does that go?
Yeah, it's usually a combination of a couple of things. So the first thing is that because the grocers all have private label programs, they are very, very well informed on what cost of ingredients are, which ingredients are being imported, packaging costs. So when a counterpart from a packaged food company comes to them and says, we need to increase prices because of X, Y, and Z, the retailer can call them out if they don't see the same pattern that they're being given as an excuse. Now, then there's a collaboration where ultimately both the retailer and the packaged food company want to, increase the volume sold and make sure that their products are getting in the hands of customers. So when it comes to pricing, usually there can be a bit of a sharing in terms of cost, but most of it does fall onto the packaged food company itself. And that comes in the form of having to do promotions, or offering discounts and things like that to make sure that their products are actually moving and that they're generating turnover and that they're then getting some profit out of it.
Jen, thanks so much for joining us. Always appreciate it. Always learn something. Speaking to you, Jen Bartashis, Senior Retail analyst for Bloomberg Intelligence. I mean, Jen had a real career at Bloomberg. She was managing departments, managing a bunch of people in global data. And then we asked her, like 15 years ago, hey, come to Bloomberg Intelligence. We think you'd be a really good analyst. And she did come over, she accepted, and she's been great. And now she's one of the leading voices on retail. So another success story coming out of Bloomberg Intelligence. eToro.
That's amazing.
That's a cool platform here. Went public yesterday. Stock had a great IPO, right?
It did have a great IPO. I actually went out 5 years ago. I was already talking to Yoni, and it was amazing because it grew so much in the past 5 years. And look, now they're popping.
eToro, E-T-O-R, went public yesterday, surged about 29%. They upsized the deal there. More shares, higher price, stock traded higher. It's off about 3% today, giving back, but just a real solid IPO, a solid growth story. And it's something that a lot of market investors are looking and say, hey, we got a little bit of a rebound in this market. Let's see some IPOs come to the market, because a lot of them were pushed off during some of the volatility of early April. And now some of those IPOs are coming back. Coming up right now, we're going to check in Yoni Assia, the eToro CEO, speaking in just moments with Bloomberg Television anchors Ed Ludlow and Caroline Hyde, talking about the business, the IPO, and the future of financial services. Again, eToro, a really unique financial platform for global financial services. Yoni Assia, eToro CEO with Bloomberg Television. Let's listen in.
We want to welcome our worldwide TV and radio audiences. We look at shares of an investment platform, eToro, stabilizing a little bit after a pretty hyperbolic debut in public markets. Yesterday, the competitors of Robinhood began publicly trading at $52 a share. The upsized IPO raised nearly $620 million for companies and investors. We're joined now by eToro's CEO, Yoni Assia. Yoni, for both Caroline and I, it's a little bit of a sort of full circle story, because I'd say over the last decade or more, eToro is a company we've probably most consistently talked about. Finally, you've gone public. Actually, when shares started trading, it was well above $52. How does that feel for you?
It's an amazing feeling. You know, the last 2 weeks on the road show, being inside capital markets here in the U.S., now listing on NASDAQ, a super exciting journey, 18 years in the making of building eToro, the world's largest social investment network, and now our customers can trade eToro on eToro.
Educate the audience that doesn't necessarily know about eToro. What is the proportion of stock activity on the platform versus, say, crypto? What is the mainstay of your business?
So we're doing both. Customers today on eToro can trade stocks from over 20 different capital markets, as well as more than 130 different crypto assets. We started the business in Europe and the UK. Our largest market expanded to Asia, UAE, and now the US as well. And our customers, when they trade, they share all of their trading activity, and you can actually see the portfolios and the track record of our customers, and you can automatically copy the most successful investors on the platform. So it's not only about trading yourself, both crypto and stocks, it's about being able to see others that are successful and copy them automatically. And the ratio between stocks and crypto changes in market dynamics. Last year, 25% of total net contribution was actually crypto trading activity. Years when crypto was in a bull run like before, sometimes it's up to 62%, so it really changes with the markets.
We keep comparing you to Robinhood, and at the moment, you have a social nature, of course, which you were spelling out in the way that you can copy those and invest like them. But with Robinhood at a 52 billion market cap and yourself at a 5 billion as it currently stands, how do you close that gap? How do you show that you're more close in terms of competitors?
I think eventually a lot of great companies are aiming at a very, very big opportunity, which is the largest generational transformation of wealth in history. $84 trillion here in the US are going to move from older generations to younger generations. in Europe, not that far behind, $60 trillion are going to move from older generations to younger generations. And I believe that our generation expects to trade, invest, and save in a digital native solution. And we're providing more than just the ability to trade directly in the markets. Through the copy trading patent technology, we provide people to automatically copy top investors from all around the world, as well as more than 100 different smart portfolios, where we actually have our own chief investment office with 16 market analysts across the globe who help our customers basically find portfolios like thematics, driverless cars. We're just launching now also market neutral strategies, learning from the hedge funds I met here in New York. So we're able to create more than just self-directed trading, but actually the entire world of investments through smart portfolios and copy trader.
And that's as the business model matures, Yoni. It's interesting that you sort of said you have got yourself to a more mature state than back in, say, 2021 when you were looking at going public via a SPAC. Just tell us how different it looks now and what happened then to make you push to go for an IPO this time.
I think, we call 2022 the year of education. A lot of our customers learned that markets don't always go up. And we were focused initially in 2021 really at growth at all costs strategy, very sort of VC-minded, let's just spend money to grow. Okay. And I think what 2022 taught us is to change our strategy to profitable growth. And we've significantly scaled up profitability in eToro with more than $300 million of adjusted EBITDA profit. So I think that's the significant transition that we've done in the private market, bringing us to profitable growth, which is a strategy that I believe is more fit to public markets.
There was a lot of demand, and now we see a lot of more IPO sideline waiting companies wanting to follow your tracks. Yoni Assia, it's great to have you back on the show, CEO of eToro. Thank you. Now,
all right, that was Yoni Assia, eToro CEO, speaking with Bloomberg Television's Caroline Hyde and Ed Ludlow. Again, eToro, E-T-O-R is the ticker. Went public yesterday, $52 a share. It's now trading at $64.60. So a nice move. Good for them. And I think good for the IPO market. Once you get a good success story, maybe some more will follow. So interesting discussion there. We've got the market turning a little bit positive here. Let's check in with John Tucker and get a Bloomberg Business Flash, John.
Yeah, shedding some of the earlier losses. This Bloomberg Business Flash, by the way, being brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. And the major stock averages, as you mentioned, turning mixed right now. The Dow pushing higher, up 70 points. That's about 0.2%. Leading the way, their shares of Cisco, Verizon, and Amgen. Cisco Systems benefiting from demand for systems that use AI technology. The company issuing a pretty solid forecast for revenue in the current quarter. Cisco also helping push the S&P 500 higher. That's up, well, just 3 points, but it is higher. Along with shares of Steris PLC. This is the provider of infection prevention products. They reported their life sciences revenue for the fourth quarter that beat the average analyst estimate. Give a little love to bond yields right now. They are falling. We did get the tame inflation data and kind of lackluster retail and manufacturing readings. So that boosts the case for the Fed cutting rates this year. The money market's reflecting slightly higher bets on at least 2 Fed reductions for this year, and that would start in September. The 2-year, 6 basis points lower. That's at 398. The 10-year, 7 basis points lower, 446. Again, the Dow up 75, S&P 500 up 4, the NASDAQ 100 6 points lower right now, shedding a lot of its earlier losses. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Isabel and Paul.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. I don't think it's raining. Good news. We're also streaming live on YouTube as well. President Trump making lots and lots of news in his trip to the Middle East. Lots of economic deals being announced. Big dollar amounts as well. All that is good for the companies involved. But he does call out Apple. Tim Cook not there with him, as Jensen Huang is of NVIDIA. Also suggesting that Apple should stop moving iPhone production to India. What is that all about? Anurag Rana, technology analyst for Bloomberg Intelligence. He covers Apple. He covers all this tech stuff for us in the burgeoning tech capital of Chicago, Illinois. Anurag, Apple Computer, they're trying to diversify their supply chain, maybe get a little bit less reliant on China, taking some of that over to India. Does the president not like that?
Yeah, we just heard that, and in fact, it looks like Apple cannot, catch a break right now. We thought that the U.S.-China deal would probably put a lot of those fears to rest, but it just looks like that he's not happy with Apple moving some of that iPhone facilities to India. Now, that is the case because, frankly speaking, you do need a low-cost labor setup. You do need really large factories and the amount of labor to assemble some of these products. Remember, even in an iPhone, the chip can come from a high-cost region, but the assembly of the phone, cannot be done in a high-cost region. So I think they are in a bit of a jam as to what to do because we have. Bloomberg News reported that they wanted to double their capacity in India to ensure that they don't have to pay the high tariff rate coming out of China. But let's see what Apple does to counter that. Our best gut feeling is that they will ramp up the investments in the U.S. and perhaps target more on the higher margin items such as chips or really expensive Macs. But it'll be tough for them to do this on the iPhone level, frankly.
But that's the thing. Apple already promised to hire more workers domestically here in the U.S. and spend $500 billion over the next 4 years. So you think they will need to add more to that?
Either they need to add more to that or support some of the local manufacturing, perhaps in the chip capacity, or explain to the president how they're doing it in the U.S. A lot more benefits to, the local workers because, for President Trump to call him out, out in the open, does put him in a tough position right now.
What is the Apple strategy here? Because again, we think of some of the quote unquote China exposure. The company that comes to the top of most people's list is Apple because they get 20% of their revenue from China. Their supply chain is fully enmeshed in China. And I know we've talked to you, for the last several years about how they can diversify here. What is the reality in today's world for Apple?
See, the reality is the higher value products. So let's say the chip that they do or they make, those are all designed in the U.S. It's made by TSMC. Those plants have been shifted, some of them to Arizona. So the higher value products can be done. But frankly speaking, think about it, lower, whether it's an AirPod or whether it's just an assembly of the phone. It's not that easy to just, come up and make those things in the U.S. I mean, they've been trying to perfect that over a 20-year period across different parts that they get from China, the factories that employs, hundreds and thousands of people. It's just not easy to move those. I think they will be pushing a lot more on the R&D front over here, hiring more local workers to offset some of that, which means at least over the next few years, there could be some downward pressure on their gross margins, in order to, showcase that they are investing heavily in the U.S.
How has it been like as an analyst covering all the tariff flip-flops and all these big tech companies that are at the mercy of some of Trump's pronouncements that are sometimes really unexpected?
I mean, really, listen, it is very tough. And frankly, we're going to see how and if this leads to some kind of demand destruction on any of the, end markets we cover. So far, it doesn't look like it's having an impact on the cell phone market. It doesn't look like it's having an impact on the cloud market. But when you look at something like consulting market, I mean, it is having a second degree impact because people or companies are not sure how they're going to be, what kind of economic environment they will see down the road, whether there'll be a recession or not. So there has been an absolute stop in a lot of the consulting work and a consulting related, bookings or contracts out there. And I think that's kind of what we are seeing, at least in the overall tech space right now.
Anurag, thanks so much for joining us. Always appreciate getting a couple of minutes of your time. Anurag Rana, he's a senior technology analyst for Bloomberg Intelligence. He and Mandeep Singh kind of lead our global technology research. It is a global technology research team. We've got analysts on the ground, North America, Europe, and most importantly, Asia, given where that is in the supply chain there. So Anurag and Mandeep manage that business for us. What are you looking at?
I'm just really I'm surprised because imagine Apple, you're a big company, $1 trillion market cap, And the president said shift out of China. So you do that and you go to India. And now they're saying, why are you in India?
Right.
And I just don't want to be Tim Cook right now.
Yeah, it could be a tough situation, but all companies are dealing with and trying
That's
to
fair.
adapt. And one thing
Exactly.
Tom Keene always says is companies adapt, whether it's a global pandemic or whether it's trade tensions, companies adapt, consumers adapt, and that's arguably what the tech industry and global trade will do as well. Looking at the markets here, got the S&P up 4 points, no real movement there. The Dow's up 85 points. NASDAQ is off 58 points. So at the index level, not a lot of movement here today. The VIX is quiescent, as Tom Keene would say, below 19. 10-year Treasury yields coming in noticeably, about 7-8 basis points. We're now at 4.45% on the 10-year Treasury. Bitcoin, I'll call that out for Tom on the Upper East Side. It's off almost 1%, just under 103,000 on your cryptocurrency. Gold higher, $3,200. How about that? This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages, they have shed the earlier losses. 7 of the 11 major industry groups in the S&P 500 higher now. They're being led by utilities. Now, the individual leaders include Steris and Cisco Systems. Steris is the provider of infection prevention products. The fourth quarter life sciences revenue beat the average estimate. Cisco, the company's revenue forecast for the quarter, looks solid, slightly exceeding analyst estimates. I always say about Cisco Systems, the company founded on love. The two founders were at Berkeley, and they wanted to communicate with each other, and they set up a system. And they had to go into the sewers to do it. Anyway, they both got fired and now divorced. Walmart, the biggest retailer, another quarter of solid sales and earnings growth, but the future kind of looks cloudy. As a result of that, shares of Walmart 1.2% lower right now. But again, off the worst levels of the session. Mike Dart, meantime, at Roth Capital Partners says the risk of recession has dropped.
So I do think we can breathe somewhat of a sigh of relief here. If you look at the high yield debt market, those spreads shot up dramatically going into the first week of April. Basically a 50+% recession probability that's now receded down into the teens, if not lower.
And some of the other stocks on the move. Deere, the big green machine for Moline, remember that? Surging to a record, earnings beat the highest of analyst estimates. Overall, the S&P 500, 9 points higher right now. That's up 0.2%. 59.01 on the index. The Dow Jones Industrial Average up 104, and the Nasdaq 100 14 points higher right now. That is up about 0.1%. Yields continue lower. The twos down 7 at 398 right now. The 10-year down 7 basis points. That's at 446. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Isabel and Paul.
All right, JT, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan. We're streaming live on YouTube as well, so check us out there. Nancy Tengler joins us here in studio. She's usually out with her horses out in Scottsdale, Arizona, but she's here in New York, slugging it away in Midtown Manhattan. She's the CEO and Chief Investment Officer for Laffer Tengler Investments. Nancy, it seems like investor sentiment it just whipsaws. I mean, you think back to the underperformance through April, people were so negative on the marketplace. We're talking recession, empty shelves, blah, 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 companies pulling guidance. And now the stock market's retraced most, not all, but most of those big sell-offs from earlier in the year. What do you make of kind of the market psychology here?
So, Paul, I think some of it is the algos that then feed into the hedge funds. And so their time horizon is the next 2 to 3 days or the next 2 to 3 weeks. What we do is we use that volatility to create opportunities for ourselves. So we were adding to a number of the tech names earlier, after tariffs were announced on April 3rd, and then also before that as they sold off from the mid-February peak. And so I think what investors have to do is they have to extend their time horizon, look at the trends, not the daily numbers. You saw Cisco today. That was a good report from an old economy, not sexy technology company. And I think much of the deals that we've heard announced, we'll see how much of those deals come through. But the deals that we've heard announced in the Middle East, that's not factored into their numbers. So I think you still want to be long technology, the AI names, some of the infrastructure names for like Quanta Power and some of the others that we own, and I can't remember at the moment, and just stay long that trade because we're not going anywhere. And the old economy companies that have embraced the new technologies like Walmart are still delivering, though we'd been trimming Walmart earlier this year.
To Paul's point, I mean, if you look at the dynamics of the market, it's not really risk on. We just have this few handful of tech stocks really carrying much of it. Why do you think investors are avoiding havens like long-term bonds?
Well, Isabel, because I don't think anybody knows where rates are going. I think one of the problems, like why is the 10-year up? I mean, I could give you an answer, but it would probably be fake because I don't really think anyone knows. I think there's a lot of trading, again, the hedgies around the edges, but I think it might be too soon to extend duration. Our team thinks bond rate yields are going up. but we're not yet ready to extend duration materially.
Talk to us about small mid-cap stocks. How have you guys historically looked at mid-caps versus today versus maybe other periods?
Yeah, so we just launched a new mid-cap strategy. Our feeling is that it kind of benefits from liquidity, AI, many of the things that and M&A that don't necessarily happen in the small cap space. I mean, they're on both sides of the M&A, which is kind of cool. So we like that space better. I've been watching the group. I used to manage money for the Bechtel family and corporation in San Francisco, and we went out and searched for small cap managers. It's very difficult to find a long period of time where small caps outperform. It's usually short, it's a trade, and so we wanted to be exposed to mid cap, and that's what we're doing because we think it feeds nicely into the large cap space.
And what are some mid cap names that you like?
So we have a bunch of names. I met with the team yesterday. They gave me Rockwell, which of course is automated manufacturing. They got clobbered and then they've had a nice run, but we think you still want to be in that stock long term. Iron Mountain, old economy company, which is paper storage, but also that's funding their digital storage business. And oh boy,
Duolingo.
Thank you.
Look at that right here. A lot of people swear by that.
Three names. I couldn't remember the third one.
A lot of people swear by that.
Yeah, very low attrition, subscription model. It's where you want to be in that particular space. And that's kind of our theme across. Like, we want companies that have sustainable earnings growth. We are in a decelerating earnings environment. We just don't know, and economic environment. We just don't know how much yet. And so that's why we want to have exposure to reliable earnings growers.
Nancy, for, at least since the great financial crisis, technology's led this market. I mean, you don't have to spend a lot of time on this stuff. Is that still the case? Do you think is tech still, as tech goes, so goes the broader market, do you think?
I still think that, Paul. I know there's a lot of naysayers, but, go back to the 90s when we had the poster child of overvaluation, Cisco, that was run, it was trading at 100 times peak earnings, run by John Chambers, who has now come out as a VC and said, AI is more powerful than the internet, which was all we had then, and cloud computing. So I think if you believe that, and I do, I mean, I'm using AI more and more. I use Grok 3. I don't know. Most people use others, but I love it, and I utilize it daily. That's just me, but at the margins we're hearing, that was the theme we heard from companies in the last earnings report, that they're employing more and more AI. Microsoft just laid off 3,000 middle management people. We heard Meta say they're going to use AI to write AI code. And I think that we're going to see more and more of that in technology and outside of technology.
Given all of this, how are you adjusting, if you are, your recession probabilities or your models?
So we don't really forecast recession models, but we do have an opinion, and we don't think we're going into a recession. If I had to put a percentage on it, I'd say 25% chance.
That's
because
low.
It is low, because you don't know. The tariff flip-flops have been epic, and the deals that we've heard about need to come to fruition. But I think what we're hearing from the companies is that they've navigated so far, tariff noise pretty well, and they've made some adjustments. So I thought the business inventories numbers today was very interesting. I would have expected it to be much higher given the pull forward, because we saw custom duties payments go up double month over month from March to April. So
epic is a great word.
Yep. All right, Katie from Bedminster, New Jersey writes in and says, hello, Katie Greifeld. She is a big fan of Nancy Tingler, and she's also a horse owner, too.
I love Katie Greifeld.
Horse owners, you're an odd lot, let's be honest. I mean, that is hard work.
It is, and you know what? I look forward to it. Hi, Katie. I look forward to it every morning.
I know a bunch. It is
good for the soul.
It is. It's good stuff. So anyway, Nancy Tingler, thanks so much for joining us.
Thank you.
Nancy Tingler, CEO, Chief Investment Officer at Laffer Tingler Investments, based out there in Scottsdale, Arizona. But we got her in our studio today. S&P 500, we're up 14 points. The Dow's up 120 points. That's 0.3%. And NASDAQ off a couple of clicks here. Nothing to write home about. WTI crude oil for Alex Steele. It's off $1.50 today. Still around $61.50. She's down in a refinery, a hot, sweaty, smelly refinery somewhere in Louisiana, and she could not be happier. We're going to have more coming up. This is Bloomberg. Good morning.
listening to Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
All right, Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming on YouTube as well. All right, you've heard me say it before. One of my favorite companies out there is Deere. DE is a ticker symbol. The green tractors. It just screams Middle America, American manufacturing. Another name is Boeing. To me, that just screams engineering excellence. If I were a portfolio manager, I'd be tempted to own these things all the time. But of course, Deere's cyclical. Boeing's got its issues. You got to be smart here, but Deere hitting an all-time high today, $523, which begs the question, why don't they split the stock? But it's up 5% here today, some good numbers. We've got a really good analyst who covers Deere and all this parts of the U.S. economy, these big equipment manufacturers. Chris Ciolino, he's a senior U.S. machinery analyst for Bloomberg Intelligence. I remember when he was an associate. He did well there, so we promoted him to analyst. He did well there, so now we promoted him to senior analyst, and he's just killing it, and he learned from one of the best in Karen Ubelhart. Hey, Chris, talk to us about Deere here, because I look at Deere, it's a call on the U.S. farmer. Talk to us about what you learned from Deere in their quarterly earnings here.
Yeah, you're too kind, Paul, but it was a solid print. Better than expected margins across the board. The margin performance in their production precision ag business, which is really their biggest earnings driver, was particularly strong despite a pretty significant top line decline. So really solid execution in a tough market. Yes, they did cut the outlook, but that was expected just given the uncertainty around tariffs and trade. The new guide implies something in the neighborhood of $19 a share in 2025, which is slightly above the street. So not as bad as maybe some had feared. And really, I think the big takeaway from these results are that it really kind of further solidifies that earnings will bottom this year, and that I think we're looking towards a cyclical recovery in 26 and beyond.
What was the differentiating factor for Deere? Because we have rival tractor makers like CNH reporting lower first quarter sales.
You know, I think one of the biggest takeaways from the ag equipment OEMs and really broadly within machinery this quarter was that I think the tariff situation and the impact is much more manageable than many had anticipated. The second quarter performance with CNH and with AGCO and even with Deere here was better than expected. I think we were expecting something a little more draconian. It's very manageable from a cost perspective. I think the bigger concern and where we still have some trepidation is on the demand side of the equation, if in fact, we see a potential re-escalation or a lack of a de-escalation on the tariff front, particularly around China, what that would do to U.S. crop exports and the demand impact on 26 and really beyond. So it was really a solid quarter for all OEMs, and I think, we're looking towards what the trajectory of the recovery will ultimately be.
Deere, located in Moline, Illinois, literally the middle of America. So that is cool as well. Chris, nobody's got a better view of the U.S. farmer than Deere. What are they saying about the U.S. farmer today? And is, again, in a world of kind of uncertain tariff environment?
Yeah, we heard from Deere on the call, finally starting to allude to some sense of stabilization in terms of the farm economy. Crop prices continue to remain under pressure, but, relatively steady sequentially here. The government did issue some handouts, and they, acknowledge roughly, I think, 75% of the $10 billion have been distributed. So I think that's provided them with a little bit of liquidity. We're still, farm fundamentals are pressured and likely will be for the balance of this year. But again, I think we're probably approaching a trough, not only from a farm economy perspective, but also from an earnings perspective for Deere and the rest of the OEMs.
And we have tractor sales trending lower since 2023. Are we expecting an uptick soon, or is this going to plateau? What are you expecting?
Yeah, that's the big debate right now as to what the shape of the recovery looks like. From a volume perspective, we're going to be down roughly 30% in terms of large, high horsepower tractors this year. It'll be the second year of double-digit declines. We're probably going to be, near the lowest level in really 2 decades in terms of volume. So I think there's probably limited downside risk from that perspective as we move forward. It's just like, what does that trajectory look like in 26? Right now, our expectation is that we're going to see a much more muted recovery than what we typically see in a normal cyclical upturn. Historically, we see, you know, anywhere in the 10 to 15% increase in volume in year one of a recovery. We're thinking it's kind of more in that low mid-single digit range until we get better visibility on the trade situation.
All right, Chris, thank you so much. We appreciate it. Chris Ciolino, Senior U.S. Machinery Analyst of Bloomberg Intelligence, along with Lindsay Dutch, another one of the folks that Bloomberg Intelligence developed, took them right in, trained them up, gave them the resources to succeed, and there they go. So we got some great senior research talent, homegrown at Bloomberg Intelligence. Chris is one of those guys covering the machinery companies for us here. And you know, God, if you're Deere, the stock's at an all-time high. And it kind of goes back, and I see a stock with a $500 handle. I'm like, split the stock price.
Yeah.
Take a 10-for-1 split. I mean,
psychologically.
But it's less relevant today because you can buy fractional shares.
That's true.
You know, and which you couldn't do back in the day. So I mean, that kind of reduces the need for that. So, but anyway, great quarter for Deere in terms of maybe setting the bottom for that notoriously cyclical business of farm equipment. All right, folks, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by ShipStation. Stay with us. Your top stories and global business headlines are coming up in just a moment. S&P 500, it's up 13 points. The Dow's up 127 points. The NASDAQ is down 24 points, so a little bit of a mix there. We're going to have more coming up. 10-year Treasury yields 4.45%. Stay tuned. Global headlines coming up right now. Good morning. 12:43 trade.
Thank you. Day is done for you.
Yep.
Gosh. Thanks, Mom.
Thank you.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. The bid by President Trump to end birthright citizenship is before the Supreme Court.
This order reflects the original meaning of the 14th Amendment, which guaranteed citizenship to the children of former slaves, not to illegal aliens or temporary visitors.
Solicitor General John Sauer, Justice Elena Kagan.
If I were in your shoes, there is no way I'd approach the Supreme Court with this case. So you just keep on losing in the lower courts. And what's supposed to happen to prevent that?
The Trump order was blocked by 3 federal judges. The larger issue is a test over the power of federal courts to take individual action on a matter that has nationwide impact. Now to Milwaukee, CBS's Scott McFarland reports there was a not guilty plea today from Hannah Dugan, the judge who's accused of helping a man evade federal immigration agents.
A simple plea, little more today. But in a filing yesterday, she made more of an argument that there is a form of judicial immunity for what happens in her courtroom that is outside the jurisdiction of the executive branch. She says that it only protects her during this case. She's arguing this should protect her from having the case at all, that it should be dismissed.
Cross-examination today for Cassie Ventura, the ex-girlfriend of Sean Combs at his sex trafficking trial. CBS's Katrina Kaufman.
The singer spent over a decade in a relationship with Sean Combs, which during the prosecution's direct examination was portrayed to be one of violence, of abuse, both physical and psychological, and one where they were involved in a complicated scheme of sex trafficking. All the prosecution says at the direction of Sean Combs.
The government says retail sales increased slightly last month. Federal Reserve Chair Jerome Powell this morning assessed tariff policy.
We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks.
I'm Jim Crisula. If you shop at Walmart, you will soon be paying more. The nation's biggest retailer says it will be raising prices because of President Trump's tariffs. Much of what Walmart sells is made in China.
CBS's Nicole Killian is on Capitol Hill, where Republicans are still tweaking a budget bill.
As far as the speaker, his main goal is to get this over the finish line before the Memorial Day recess, so he's trying to stay steadily focused on that. Obviously, now that work has completed within pretty much most of the House committees, it wasn't just the 3 this week, but others earlier this month that had been marking up the bill as well.
Wall Street, a turnaround. The Dow is now up 131 points. The S&P is up 12. NASDAQ is down 25 points. This is CBS News. The top baby names remain the same, but some old favorites are climbing the charts.
BabyNames.com says classic old-fashioned names are all the rage again. For girls, think Eleanor, Eloise, Elodie, Alma, Margaret, Nora, and Bennett. For boys, Theodore, Oliver, Owen, Silas, and Jasper. One consultant says they offer just the right mix of vintage soul and modern edge. Another suggests parents look for inspiration by visiting nursing homes and graveyards. Despite the trend, Liam and Olivia still top the list of the most popular baby names. Deborah Rodriguez, CBS News.
55-year-old Louis Pugh aims to be the first person to swim around Martha's Vineyard in Massachusetts to educate the public on sharks. He began today and hopes to complete the 62-mile swim, an information session over the course of 12 days. Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
It's do or die time for SALT. Welcome to the Thursday edition as House Speaker Mike Johnson pulls the warring factions of the Republican conference into the same room to come to terms on a SALT cap so reconciliation will move forward. This is happening as we speak, and we'll get the latest on a fast-moving story coming up from Jack Fitzpatrick at Bloomberg Government. He's live on Capitol Hill. President Trump now on day 3 of his journey through the Middle East, arriving in Abu Dhabi, as you can see right now on YouTube. We'll discuss with Bloomberg's Jenny Welch, and we'll compare notes a little bit later this hour with Bloomberg's Mark Gurman, our Apple whisperer, as Donald Trump asks Apple to stop moving iPhone production to India, bring it here to the U.S. Is it possible? We'll talk to our expert with analysis from our panel. Rick Davis and Jeannie Shanzano are with us, and it all follows a look at Wall Street as President Trump walks into the presidential palace. We walk into the markets right now with Charlie Pellet at World Headquarters in New York. Hey, Charlie.
Well, hello there, Joe Matthew. Lots of moving parts to this market, and Bloomberg has got you covered. Geopolitics, economic data, earnings, we're watching it all for you. Right now, stocks bouncing higher after tame inflation data this morning, combined with lackluster readings on retail sales and manufacturers, bolstered the case for Fed rate cuts this year. The S&P now higher by 19, up by about 0.3%. We've got the Dow up 179, up 0.4. NASDAQ, though, remains in the red, down 3 points now, down less than 0.1%. 10-year yield, 4.45%, with the 2-year currently yielding 3.97%. Gold is up $41 the ounce, up 1.3%, 32.18. And West Texas Intermediate crude oil, WTI, down 2.4%, 61.65 a barrel on WTI. JP Morgan Chase CEO Jamie Dimon says recession remains a possibility as tariff fallout continues to buffet global economies. And speaking with Bloomberg, Dimon told our Francine Lacqua there's still a lot of uncertainty in the economy, but some of it preceded the Trump administration.
We had large deficits, interest rates going up, inflation going up, and some are, tariffs and things. And of course, the geopolitical situation is very tense, very difficult, and hard to resolve.
Diamond spoke at JP Morgan's Global Markets Conference in Paris. Walmart delivering another quarter of solid sales and earnings growth, but it's cautioning that tariffs and increasing economic turbulence means that the world's largest retailer expects to begin raising some prices this month. Walmart down now by 1%. Dick's Sporting Goods has reached a $2.4 billion deal to acquire Foot Locker. Shares of Dick's Sporting Goods down 13.8%, but Foot Locker up now by 85%. Recapping, S&P up 0.3%, the 10-year 4.45%, the 2-year 3.97%. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, great to see you. Live in New York, Charlie Pellet, watching Wall Street for us every day here on the fastest show in politics. Welcome to Little Friday, Thursday edition of Balance of Power, live on Bloomberg Radio, the satellite radio, channel 121 on Sirius XM, and of course on YouTube, where you can find us now by searching Bloomberg Business News Live. If you're like me, you can also catch us on the Bloomberg Business News app. Find us live on the app, plug us into CarPlay on your way to work. So many ways to catch the program. And I wonder, what will Charlie Pellet tell us on the day they cut a deal on salt? Could that be today? Do we get a rally the minute that's announced? Think about where all of these traders actually live, in places like New York, Connecticut, New Jersey. And I bring this up because there's an important meeting happening today on Capitol Hill as we try to align the stars for a vote next week in the House. At least that's Mike Johnson's job, on reconciliation, to pull all together this big mess of bills and try to get something passed so it can go to the Senate. He wants this done before Memorial Day recess, but they can't get it done until there's a deal, yes, on Bloomberg's favorite story, SALT, the state and local tax deduction. And not everybody's getting along on this. You've got the salty Republicans. We've brought you conversations with many of them from, yes, states like New York, as I mentioned, New Jersey, and so on, California, too. You've got the Freedom Caucus. They don't like this idea at all. They call it a blue state giveaway. Then you've got other members of the House looking for even steeper cuts, and Mike Johnson has to corral them all. Speaking of salty Republicans, we spent some time with Congressman Lalota on the late edition of Balance of Power, his view from New York, and specifically remembering it's a $10,000 cap right now. This idea of maybe 40-80, 40 for an individual, 80 for a couple. Is that going to grease the skids? Is that the final number? Here's his reaction.
Maybe 40-80 will be an ultimate proposal. So far, unfortunately, the Ways and Means Committee has not offered us anything anywhere close to that. Sadly, they've been stubborn and not give us anything that we could possibly say yes to. We got to go back home and sell this. And a low 30K cap, when unlimited would come at the end of the year if this bill expires, wouldn't be sufficient for my constituents.
Nick Lalota, 1st District, New York, Long Island. Is that your congressman, producer James? It is, I thought so. And so they're all going to argue this out here, but nobody wants to show their cards, right? $30,000 is floated as a limit. Not acceptable, according to most of the delegation in New York and related states. And so where do we fall here? Jack Fitzpatrick is watching this very closely on Capitol Hill and joins us right now from his perch at Bloomberg Government. Jack, we just heard from the speaker here. We're very, very close to a SALT deal. We're still on path for the bill to pass next week. Is he just being optimistic, or did something happen?
He is being optimistic. It doesn't sound like there's a concrete development that has happened today. That's not to say they're not making progress. They're holding these meetings. They're continuing to negotiate. But we've heard a pretty positive, optimistic series of comments from the speaker over the last few days. And then when you check with the SALT Republicans, it's a little bit more skeptical. There's an increasing amount of frustration from the conservatives. So there was a meeting this morning where the speaker met with some Freedom Caucus conservatives as well as the SALT Republicans. We heard from Young Kim from California, who wants a higher SALT rate, who just said they're still negotiating. We heard from Chip Roy, who's an unhappy conservative, unhappy with the bill as it stands right now. He says he still has problems with the fact that the Medicaid changes wouldn't occur until 2029. He doesn't really think it's a conservative enough bill. So there's still some work left to do to get this together. As far as the possibility of a vote next week, sure, next week is next week. They're still working on it, but there is some work left to do.
Is Chip Roy ever happy? Just to digress for him, I mean, it's his job to be unhappy, right? That's the lever he pulls as a member of the Freedom Caucus.
That is usually true, but it's been unusual this year or so. The Freedom Caucus members have been much happier specifically with the leadership approach than usual. Mike Johnson is not in the position of a John Boehner. Chip Roy got a victory when they voted on the framework before it was an actual bill to increase the goal for spending cuts. Now, they're not wholly following through on that, but they have kind of played ball with Chip Roy, with Andy Harris, the leader of the Freedom Caucus. It's just a question of how happy or unhappy do these compromising figures feel when we're actually at the very end, at the finish line.
We're hearing more from Speaker Johnson, who's talking to reporters, Jack, as we hold you up here in the rotunda. If you do more on salt, he says, you have to do more on savings. This doesn't sound like we're anywhere near a deal, does it?
Well, that's the fundamental issue, is if you give more to the handful of holdouts from high-tax blue states, it changes the math. If you create more tax expenditures, the conservatives are going to be less happy, and you're going to have a harder push, possibly focused on Medicaid, maybe bumping that 2029 date up a year or two, and then that raises questions about some of the moderates who are not very comfortable with the amount of Medicaid cuts. How does that do in the House? How does that do in the Senate, where Josh Hawley has been pretty outspoken against Medicaid cuts? So it's hard to change the pieces of this puzzle without just shaking it up entirely.
Yeah. Well, just to follow the bouncing ball here, and I know that you're an expert on procedure when it comes to appropriations, Jack. This needs to kind of get done by tomorrow, right? The House Budget Committee is waiting to assemble all of these pieces on Monday, so this can go to rules, or tomorrow rather, Friday, so it can go to rules on Monday. Are these dates about to change based on the SALT standoff?
They could change if this drags on, but they don't need a deal before going to the Budget Committee. They can, really, the Budget Committee just packages these disparate bills together because that's its role in all of this, and then they can do an amendment in the Rules Committee, which is supposed to meet on Monday. So they still can work through the weekend if necessary and make changes as of the Rules Committee meeting before they take it to the floor for a vote.
Can you qualify what happened with Medicaid, Jack? We've heard so much about cuts to Medicaid. Republicans say they aren't cuts. We're just making the program more efficient and more point. Where are the dollars?
The word cut is kind of a fraught term in Capitol Hill. It would reduce the trajectory of future spending. It would not spend more. It would spend less compared to the baseline. It is very significantly focused to able-bodied adults. Ultimately, that would lead to 7.7 million people who currently have health insurance not having health insurance, according to the Congressional Budget Office. But yes, the point that the conservatives have made, that this is not just taking insurance away from everybody who needs it. It's focused on able-bodied adults who are not working. That is true. That's the focus of that measure on Medicaid.
Yep. All right, and then we get to food stamps. Tell our listeners and viewers what happened in the Agriculture Committee. 29 to 25, party lines here to cut as much as $300 billion in food aid spending. Is that accurate?
Yes, as far as we know, and I think we're going to continue to see holistic numbers come out from the CBO and other think tanks, but the major change to SNAP nutrition benefits is a shift from fully federally funded to some burden being on states. Now, the baseline they laid out is 5% contributions from states, but then there's a penalty for states that have a history of not being totally accurate in terms of who's eligible for it. That could raise it up to 25% matching from states, and that would apply historically to about half the states in the country. So it's a significant shift towards the burden being on states for funding that.
Right. Of course, I'm now supposed to ask you if all of this is going to change when it goes to the Senate, but I'm pretty sure that a lot of it is. Jack, we'll let you get back to your coverage in the House of Representatives. Jack Fitzpatrick covering this process for us at Bloomberg Government, our Congress reporter. You can find him on the terminal, of course, and online, and as often as we can get him on this program. Jack knows what he's talking about. That is the latest that we have here. Remembering budget tomorrow to assemble this thing before it goes, if they get it done, to a floor vote next week. If we get a SALT deal, the earth will shake a bit around here. We'll let you know as soon as it happens, and you know you'll have a red headline on the terminal. I'm Joe Matthew. We'll turn to geopolitics next as President Trump lands in Abu Dhabi. Is straight ahead on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg, and we begin with a headline from the Bloomberg Professional Service. Canada's S&P TSX Composite Index up 0.7% right now. That is a record. The Qatar Wealth Fund planning to invest $500 billion in the U.S. over the next 10 years. The Dow, the S&P, they're both higher. We got the S&P very close to session highs right now. NASDAQ, though, does remain in the red. Stocks rose as bond yields fell after the This morning's economic data suggested the Fed may cut rates to prevent a recession. S&P right now up 13. That is a gain of 0.2%. We've got the Dow up 115, up 0.3. Nasdaq, though, in the red, down 21, drop there of 0.1%. Russell 2000 index of small cap shares holding on to a gain of 0.1%. 10-year 4.44%. The 2-year 3.97%. Spot gold up $43 the ounce, now up 1.3%. West Texas Intermediate crude 61.69 a barrel. WTI right now down 2.3%. And Bitcoin lower by 0.4%, 103,141 on Bitcoin. United Health Group shares are plunging following a report that the insurer is under criminal investigation for possible Medicare fraud, adding to an already tumultuous week. Shares of United Health are right now down by 15.2%. Again, recapping, S&P 500 index higher now by 14 points, up by about 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, the voice of Wall Street and the New York subway, and of course, Balance of Power. Thanks for being with us here on Bloomberg Radio, satellite radio, YouTube. Find us by searching Bloomberg Business News Live. And a reminder, you can always listen to us live on the Bloomberg Professional app, CarPlay, and all the rest on your way to work and on demand as well. So he's still holding out the possibility of maybe going to Turkey. President Trump, now day 3. This is the final stop on the Middle East tour today. He's in Abu Dhabi and just arrived a short time ago, right around noontime Eastern here at the Presidential Palace, where he's enjoying another dinner. But could he make a turn for Turkey? You've heard what's going on there, right? This is not about peace in the Middle East. This is about peace in Ukraine. Volodymyr Zelensky is in Turkey for peace talks. The Secretary of State, Marco Rubio, is in Turkey. There was a thought that we would have maybe even direct talks between Volodymyr Zelensky and Vladimir Putin. That apparently is not going to be the case because Putin's still in Moscow. Unless, of course, he's working on something with Trump. Listen to President Trump before he left Qatar about 3 o'clock in the morning.
I was thinking about going, but it's very tough because of what we're doing today and tomorrow. But, you know, if something happened, I'd go on Friday if it was appropriate. But we have people right now negotiating, and I think that I just hope that Russia and Ukraine are able to do something, because it has to stop.
If it was appropriate. Interesting idea. You wonder if something might happen here in the next 24 hours, and it's why we wanted to spend some time with Jenny Welch, Bloomberg Economics chief geoeconomics analyst, with her eyes on President Trump's travels through the Middle East. Jenny, it's great to have you. I have a lot of questions, but I want to just start with this matter of the meetings involving Ukraine. Will there actually be a formal negotiation? Who would be sitting on the other side of the table from Volodymyr Zelensky, or is this about lower-level talks that somehow keep the ball in play?
Still tremendous uncertainty at this point. We're literally watching minute by minute for updates on whether talks have started, at least at lower levels, between Ukrainian, Russian, and American officials that are currently in Turkey. I would put my odds, though, on a higher-level meeting at the leader level being relatively slim at this stage. Of course, there's still the possibility, as Trump is indicating there, that he could go to Turkey. And I think if he does, that would really put a lot of pressure on President Putin to show up as well. But realistically, for these leader-level meetings to take place, there's a lot of work that has to happen in advance to set up even just the security protocols for that to take place. And if at this stage they're still not sure whether something's going to happen, I think that points to a very high possibility that they're unlikely to have talks at that level, which for President Zelensky means that he's going to be leaving Turkey and allowing potentially lower-level officials to continue conversations. But ultimately, a leader-level conversation, I don't think it's in the books for this week.
Well, as Vladimir Putin strings us along here, Jenny, you have to wonder, why would he ever give the U.S. the win of successfully mediating peace in Ukraine?
I think both sides are really playing blame game shifting here. President Zelensky agreed very rapidly to President Putin's call for leader-level conversations because he wants to make it clear that he is not the barrier to peace at this point in time. I think President Putin offered the idea of direct leader-level conversations as a way of bypassing the pressure on a ceasefire and saying, no, instead of agreeing to a ceasefire, what we really should do is have a conversation about the larger peace process here and the deeper roots of this conflict. So sort of trying to pivot or spin away as a way of avoiding the question on a ceasefire, which at this stage, Moscow isn't interested in. They have the battlefield advantage. They think that they have the ability to weather this storm, essentially, and that the U.S. will eventually sort of turn away from Ukraine and continue to reduce aid to Kyiv. And as a result, time is on their side. They just have to play a waiting game and kind of kicking the can down the road. That being said, Putin still doesn't want to look like he's the impediment. So he's trying to portray himself as being conducive and shifting the blame back to Ukraine. And I think that's essentially where we're at. It's just this constant game of blame shifting, where I think Ukraine now has the upper hand because Zelensky actually showed up in Turkey and was willing to talk and is really shifting the onus back onto Putin for not arriving.
Really interesting analysis as we spend time with Jenny Welch from Bloomberg Economics. I want to ask you a bit about Iran. While I have you here for another minute, Jenny, the Trump administration has put forth what the president described yesterday as an olive branch. It's an actual proposal for a nuclear deal. This came from White House envoy Steve Witkoff, a written proposal to the Iranians, who are sending messages through some lower-level officials in an interview with NBC News to suggest that they're ready to make a deal. Is this really happening?
I think to say, as President Trump did, that a deal is imminent might be overly optimistic at this stage. I think there's probably a lot of details that the two sides are still working out, including on the enrichment question of whether Iran will be able to retain a civilian nuclear energy program, as Tehran certainly wants to, but as U.S. officials have kind of given conflicting statements on in the past. Another major issue that they have to reckon with, and which was a problem in the original JCPOA nuclear deal, and a reason why President Trump essentially tore that deal up, is the question of Iran's regional activities, its ties to groups like the Houthis, to Hamas, to Hezbollah, where Iran in the past has not been willing to make concessions there. President Trump has made quite clear that one reason he thought that prior deal wasn't sufficient is it didn't include terms on that front. All that being said, talks have been going more positively than I think a lot of folks expected, especially given President Trump's prior stance on JCPOA. So I don't think that's to say that a deal isn't possible at some point in the future, just that there's probably still a lot of details that are being worked out actively at the moment.
Seems like the answer to almost every question I can ask you right now, Jenny Welch. It's great to see you, Jenny. Thank you. Bloomberg Economics Chief Geoeconomics Analyst and the perfect voice for today. As we return to the question surrounding the tariffs, it's interesting. We haven't been focused too heavily since this purported deal with China was floated just days ago here. But the question, of course, was, is it the point to reshore industry and use as a negotiating tool, or is it to raise revenue? Remembering the Commerce Secretary, beginning of April, envisioning what he described as the army of millions and millions of human beings, screwing in little screws, he said, to make iPhones. That kind of thing is going to come to America. That was walked back a little bit, but based on what we're hearing from Donald Trump with regard to Apple, it does kind of sound like the White House wants to see this happen. President Trump asking Apple's Tim Cook to stop building plants in India to make devices for the U.S., saying Apple will be, quote, upping their production in the United States, unquote, as a result of their discussion. I have always wanted to get Mark Gurman on this program because he's a news machine and he knows more than anyone else when it comes to Apple. Bloomberg News managing editor for global consumer tech, with us from San Francisco. Mark, it's great to see you. Welcome to the political program that you've managed to avoid for all of these years. Now our lives intersect, and I wonder what you think about that vision. I wonder what Tim Cook thinks about that vision of an army of millions turning screws in iPhones in the U.S. Is this real?
No. I mean, maybe Tim Cook wants that. Maybe he likes that idea. I can't speak for him. Maybe he is completely aligned with Donald Trump on this being what both men want. But it's also, as Tim Cook would be the first to tell you, not going to happen. There is no reality in which Apple can mass produce or do final assembly on iPhones in the United States. There are many issues, cost being a minor issue. The bigger issues are engineering, education in this country, the ability to get the right number of skilled people to do the production, the way that Apple has to fill up city blocks worth of facilities in order to produce these iPhones. It's just too complex, and it's not going to happen. This is not something that is certainly going to happen over the next 3.5 years while Trump continues to be in office. So this is nothing more than a pipe dream. Of course, Donald Trump, he's enacting these tariffs because he wants things to be made in the U.S. Of course, there are many things that Tim Cook wants. He doesn't want Donald Trump to put new policies in place that is going to hurt Apple. He wants the DOJ lawsuit against Apple to be dropped. He wants all sorts of stuff from Donald Trump, so he's going to play nice too. Is there a scenario where Apple ups investments in the U.S.? Is there a scenario where Apple does more manufacturing of components and partnerships in the U.S.? Sure. But I think what we're all talking about here is a process called FATP. That stands for Final Assembly, Testing, and Packaging. Putting the iPhones together, taking them off the assembly line, put them in the boxes, and shipping them out to customers around the world. It's not going to happen in the U.S. anytime soon.
What would an iPhone cost built here in the U.S.?
I wouldn't even want to speculate because the issue is far more than cost. It's scale and availability of the engineering resources in order to make it happen. So I don't think anyone who has an estimate of what an iPhone in the U.S. would cost is doing anything other than pulling a number out of thin air. I would tell you that I don't believe Apple would even know. There are too many parameters and too many levers here to really understand what that price would look like at this point.
A great, honest answer. In our remaining minute here, Mark, you wonder, is there a tiered system? What if Apple actually said, okay, we'll start making a couple of iPhones here in the U.S. We'll bill them as made in the USA, and they're going to cost $5,000. We'll sell them side by side on the website and see how we do. Is that something Tim Cook would try?
No, because the amount of money and resources necessary to even get the plant up and running would be preposterous. Apple tried to do final assembly on some Macs in the U.S. several years ago, and it completely backfired, and it was very difficult for Apple to pull off. And so imagine the scale differences. Macs, we're talking about thousands of units a year on this particular $6,000 high-end Mac. We're talking about 6,000 units an hour for the iPhone. So definitely this is not something that's on the table right now.
I love that. Thank you so much, Mark. I'm a big fan. I appreciate the straight scoop. Pipe dream, says Mark Gurman. What else do you need to hear? Bloomberg News Managing Editor, Global Consumer Tech, watching Apple for us in the conversation with Tim Cook. We'll assemble our panel next. You picked the right day to join us on Balance of Power. Rick Davis and Jeannie Shanzano on the way in next. This is Bloomberg.